Well, good morning. See a lot of familiar faces out there. It's good to see everybody this morning, and welcome to the newly remodeled Ivy Tech Auditorium. It looks beautiful in here. So good job, Otso. Anyway, my name's Kevin Comerford. I'm the Director of Professional Development at the Construction Advancement Foundation of Northwest Indiana. And on behalf of the Northwest Indiana Business Roundtable and the Construction Advancement Foundation, I'd like to welcome you to the 2021 Business and Economic Outlook. Now, this outlook was, it's been going on for 6 years. Obviously, 2020 did not happen, but I've had the honor of chairing this committee for the last couple years, and we're really excited about today's presentation. But I just want to recognize briefly a couple people who helped make this happen. They put in a lot of work. One is Kathy Neary. I don't know if you're in here. I know she's running around somewhere. Kathy's with Ivy Tech. She is the Assistant Vice President of Employer Connections. And really, she did all the legwork behind the scenes, so we couldn't have done this without Kathy. Also, Akko Sakowsky, he is the chancellor of this campus here at Ivy Tech. Thanks for all your help, Akko. Let's give Akko a round of applause, too. And then one of the other key members of our committee, and I just seen him walk in, Joe Core. Joe, thank you. And then just two other people I'd like to recognize. One is Andrea Pearman. Andrea is the executive director of the Northwest Indiana Business Roundtable. Without her leadership, this wouldn't have happened. And then also Don Bohl, who is with NiSource. I don't know if Don's in the room. I have not seen him, but he's going to be retiring this year. But we've had a lot of good years under Don, so let's give Andrea and Don just a round of applause. And then we do have several co-sponsors for this event, and I'm just going to kind of read through them, but we appreciate their support. It's the Lake County Economic Alliance. I know Karen Lauerman and Don Kolobowski are usually here. I don't know if they're here, but the Northwest Indiana Forum. I was going to actually have Heather speak this year, but I'm going to give it one more year to let that Ignite the Region take hold, and there's a lot of interesting things happen with him. I'm sure Don Babcock's gonna mention some of that, but also we had the Regional Development Company, Erica Dombey, financing small businesses here in Northwest Indiana. Center of Workforce Innovations, Lisa Doherty, doing a lot of workforce development. I have the pleasure of sitting on the Northwest Indiana Workforce Board, so great leader with Lisa. South Shore Clean Cities, Carl Lissick. Now, I don't know Carl, but I hear him all the time on Lakeshore Public Media doing his Green Fleet radio. So hopefully I can meet Carl here soon. But we also had the Lakeshore Chamber of Commerce, Northwest Indiana Influential Women's Association, and the LaPorte Economic Advancement Partnership. So, and then real quickly, the purpose for today's event is to provide you with key insights on trends influencing business and industry. Today's program will feature presentations from leaders in various business sectors and government agencies, and conclude with a detailed economic picture of Northwest Indiana and the United States. Now I think I'm going to go ahead and turn the mic over to our MC. Many of you probably know him. I had the opportunity to golf with Don Babcock earlier this year.
For him, so.
Yeah, we both found out we have a lot of loft in our game, so, and that's, I can't really get into that.
It's lack of blank talent.
Anyway, this man doesn't need any introduction, but Don,
All right.
thank you.
Well, thank you, Kevin.
I'm gonna go ahead and
This is such a great event. I love coming to this every year. So, I'll take some risk and step out in front of everybody, right? So, well, we got to start it this way. Good morning, Northwest Indiana. And thank you all for coming to the 7th Annual Business and Economic Outlook. We're so lucky to have the Construction Advancement Foundation and NIBERT put this together for us every single year. And I'm so proud to see all of you here, because if you're here in this whole morning, taking up your valuable time to learn about the potential of this region. You should all give yourself a hand, because not everybody does that. So you guys are the good people in Northwest Indiana, and we're going to build this thing to even be a better and better economy. So as you can tell, by my little welcome, I'm still one of the crazies here in Northwest Indiana that believes that we can have a better, brighter future if in some respects we can change some of the culture and the attitude of some people within our own region. And we are doing that. I don't know how many of you went to the Propel thing last week with One Region. Certainly that was a great event. Heather Ennis and her team have been working on the Ignite plan, which for the first time ever, we have a regional plan for economic development, and had submitted about a month ago now a request for $52 million from the state as part of the READY grant application. We should hear about that in the middle of December. And we're going to go down and make a presentation to the IEDC here with Heather, I, and Sherry Ziller with the RDA, and try to convince them to give us the $52 million and help raise the level of Northwest Indiana even higher. And then Ty Warner, and Ty over here, is working with One Region on their grant for the Building Back Better grant. And so they get past the first piece of that, it's $500,000. And then if they make past that hurdle, the potential is to go for another $100 million for great stuff in Northwest Indiana. So it's an exciting time to be in Northwest Indiana, and I'm so happy. I know a number of you are probably worried that I was going to retire. You're not worried I was going to retire, like hoping I retired. But anyway, I did retire from NIPSCO after 40, 43, 40, I don't know, 50 some years, whatever it was. I was born there. We were trying to build a nuclear plant, and then Jane Fonda stopped us, and it was over. But anyway, didn't realize she had that much clout, but she does. So anyway, so I was very fortunate that Chancellor Keon and Matt Wells picked me up from Purdue Northwest, my alma mater. And so I'm very proud to be working there now. And I still got a few good morning Northwest Indianas left in me. So, but anyway, when I was at NIPSCO, one of my strategies and one of my goals was to find good people and help them. And many of you in this very room I've had an opportunity to work with to help build our economy and make this place a better place to live, work, and play. But what I've added to that little, look for good people thing is, a quote from Bobby Kennedy used it a number of times, and it was, some people go around their life asking why. Why this, why that, why not, So then you get into I'd much rather hang with the people that dream of things that never were and ask, why not? And for our region, why not have clean water, clean air, clean soil? Why not have a great economy? Why not continue to produce 25% of the nation's best steel? Why not have a commuter rail line down to Dyer? Why not have a double track that gets you from Michigan City to Chicago in an hour? Why not have a strong Gary-Chicago airport? Why not produce 25% of the nation's best steel and some of the best fuels in the nation? We need more people thinking about why not. Why not have the 61st National Park? Why not have 3 million people visit the park every year? Why not have beautiful downtowns? Why not where's Phil? Phil, in the back, Phil Taylor. Why not take a 100-year-old iconic bank building and turn it into 100 new fabulous apartments in downtown Hammond to help them with their revitalization? So what I'd encourage all of you is to think a little bit more about why not, because today we've got a whole bunch of presenters who are why not advocates. These are the why not people. And my first why not person is Akko Sakowsky. So come on up, Akko. So we're lucky to have such a beautiful facility, and it's just recently got upgraded. So now instead of having to turn like this and read the screen this way, he's got this new high-tech screens over here in the corner, so you can actually do that. So Akko, please, make a couple comments for us, please.
Thank you, Don. Good morning, everyone. Do you believe that there is one person bigger cheerleader for Northwest Indiana than this gentleman? He deserves another round of applause. They told me I have about 2 hours to make the speech. I'll see if I can make it in a few minutes. But with all seriousness, I'm so delighted to welcome all of you here. It's exciting, again, to have all of you back here in this auditorium. Last year, 2019, 2020 doesn't exist for us, right? Right? So I'm so excited to see all of you and to hear all the facts and what influenced the economy in Northwest Indiana. Great things are happening. I'm not going to repeat what Don mentioned about the grants and all of that. But when he talked about why not, I'm going to be careful how I'm going to explain this. But when we talk about we are losing jobs, slightly I disagree with that. What I agree is the jobs are being transformed. What's used to be even 2 years ago, they don't exist anymore. We, as educational institutions, which we have the best ones right here, Ivy Tech, PNW, IUN, Cal College, Valparaiso University, there is no any other region in state, I'm sure even in the nation, has this kind of educational system in such a short area, so to speak, and offer all these programs, what we can train the best people right here in Northwest Indiana. Let's make our neighbor states to be jealous, right? Double track, it's coming. Huge projects. The largest project, solar panel, $1.5 billion is coming right here in Northwest Indiana, right? Dunbridge and all of this. And I'm so grateful to the forum and One Region through these grants being able to support this initiative, what is coming right here. Center for Workforce Innovation, huge part in that. Thank you so much, all of you. So anyway, I wanted to say again, thank you for being here. Thank you everything what you do. At the end of the presentations today, if you have time, I would love to show you what we have done last year, what did not exist for us. But we open up state-of-the-art simulation lab for the nursing program, which is almost like an intensive care unit on the second floor in this building. And we are doing some stuff in terms of the renewable energy because we already create one of the best programs partnering with NIPSCO for the energy program. And I have to mention, since now all stations, they're going to be shortly retired, the power plants, and we had a track to be power plant technician. Now we are going with a renewable energy pathway. So those of you who wanted to stick around and to show, to see what is available, we're going to make that happen. So before I'm going to turn over back to Don, I really wanted to recognize Kevin. Kevin, thank you so much again for partnering and putting this all together. Round of applause for Kevin, please. He mentioned Kathy Neary from Ivy Tech, Assistant Vice President from System Office. Thank you, Kathy, for being here and helping. Andrea Pearman, already mentioned Kevin. Thank you, Andrea. Thank you, Northwest Indiana Business Roundtable, for putting all this together. And of course, on the behalf, and I really appreciate all my faculty and staff putting together everything what they do every day, and especially to make sure that today's event is going to go nice and smooth. I really appreciate for their attention to this as well. Couple of things. Yes, thank you. Couple of things. We are hoping that everything is going to go as we are expecting, but in the case of emergency, please use these two doors and that goes outside. Don't go inside, just go outside. Knock on the wood, nothing happened, but just in case, that is the outside. And for those of you who are first time here on the campus, for the break and when you need to use the restrooms, there is one set behind the bookstore on the right-hand side, and there is another set on the right-hand side down the hallway. So again, thank you so much, and I look forward for this, one of the best presentations. Enjoy.
Thank you, Atso. So I'm doing pretty well. I already messed up his introduction. So how many of you came farther than Macedonia to be here? So Atso got his electrical engineering degree in Macedonia. Then he came to Indiana and got his master's in engineering from nobody other than Purdue University. So thank you for joining us. He's been an inspiration since he came in 1997 to Ivy Tech, and he's just done a phenomenal job here. We don't have a better champion in education than Atso, so thank you so much. You did mention nursing, by the way, so I have a quiz for everybody here. So if you had to guess how many people graduated in nursing from Purdue Northwest on an annual basis, what do you think the number is? How many people do you think graduate every year from Purdue Northwest in nursing? 500? 600. Anybody else? 3,000. Well, the numbers between, I don't know, I saw Liz DePue here, I think it's 650 to 700, something in that range, every single year. So there's a pretty good chance a very good chance, high probability, if you're taking care of in a health facility in Northwest Indiana or in Chicago, that you're being taken care of a nurse that got their education right here in Northwest Indiana. So interesting statistic is when I came out, and I'm looking for stats at Purdue, what could I talk about? And I'm going, 700 nurses, where do they go? I mean, how many people need that much help? But obviously there's a huge demand, so we're glad to supply that. So without any further ado, let me get down to our next interesting speaker here, if I can find her resume, because Allison, I know you came all the way up from Louisville, right? So that's not quite Macedonia, but that's a pretty good drive, so thank you. Allison is the Executive Director of Workforce Program and Services for the Indiana Department of Workforce Development. She's worked in the arena of workforce development for several years, serving in capacities at the local Workforce Development Board and now in her current role with the state of Indiana. Her current role with DWD is focused on how the state's workforce programs, services, and resources are strategically aligned and leveraged to achieve the greatest impact for Hoosier families and businesses. DWD, in partnership with local workforce development boards, aim to ensure that Hoosiers across Indiana have access to the resources and support needed to gain employment, advance their skills, and access the many thousands of jobs made available by Hoosier businesses. Allison's presentation will focus on next-level jobs, incumbent worker training, and understanding the Workforce Innovation and Opportunity Act. I also know you work closely with Lisa Doherty, right? Where's Lisa? Lisa's here somewhere, so thank you. So this connection with Indianapolis to our region is very important. And so please give Allison a warm welcome from Northwest Indiana and a long drive this morning. I know it's hard to get here, but thank you.
All right. Well, good morning. Thanks so much for having me. I have to say a few thank yous here because, like Don said, it's quite a trip up, but I'm happy to make it. I've made some amazing memories in my time here in Northwest Indiana. So Kevin and Kathy, and also thank you so much for the invitation back. And as Don said, part of the presentation that I have for you today is really going to reflect on the challenges that we've had over the last couple of years in really how we can start to look at things through a prevention and a preservation method with some of the tools and maybe some of the more underutilized tools that we have available in workforce development. So to kick things off here, I'm going to probably talk about a program that's pretty familiar to many of you, the governor's Next Level Jobs initiative that focuses on employer training grants and workforce ready grants. So to spend a little time on the employer training grant piece just a little bit here, 727 businesses received employer training grants last year, up to $50,000 apiece. 78% of these were small to medium-sized businesses who we know were impacted the most by COVID and some of the other challenges that were faced. And we know that the businesses that were predominantly taking advantage of this were in manufacturing, health and life sciences, and building and construction. So that was amazing to see those funds flow through, in many ways, many businesses here in Northwest Indiana and throughout our state. But I will tell you, when we opened things up in July and made applications available for another round of funding for this, within 14 days, we had over 750 applications from businesses who were requesting up to $50,000 to train and upskill their workforce. So all that to say, wow, that speaks to the level of need that our businesses have here in Indiana, and really it tells us that we need to reflect on solutions like this to help make sure that those businesses are thriving and that Hoosiers have the opportunities to be able to access those different jobs. So as you can imagine, our teams at DWD now and locally here at the Workforce Board are working feverishly to work through all 750 of those applications and get those funds out. But as we do that, it doesn't mean, if we reflect on just the 750 businesses that applied, I forgot to mention this, it would probably, if 100% of those were funded, it would more than double the allocation that was available for employer training grant alone. So there still remains this gap that we need to identify solutions to fill. So now I want to talk a little bit about Workforce Ready Grant. When we think about next level jobs, a lot of times they're viewed as two pathways, one pathway for a business and one pathway for an individual. But in actuality, both pathways are available for both a business or an individual. And so it's designed to meet the individual or the business wherever they might be. So in the employer training grant, those funds are directly provided to the business, and in Workforce Ready Grant, those funds are directly provided to the individual. But certainly businesses who might have individuals within their company that could benefit from upskilling could certainly direct, incentivize individuals to participate in Workforce Ready Grant. So to give you a little picture about what happened this last year with the Workforce Ready Grant, just over 25,000 Hoosiers were upskilled via this grant. And this is between partnerships with our local workforce boards, with CHE, DWD, and then obviously our post-secondary institutions like Ivy Tech, who are working tirelessly to make sure that they are making this accessible to students. We know that predominantly they were accessing training in health and life sciences, IT and business services, and transportation and logistics. We did see a significant uptick in the amount of training that was provided in IT and business services over the last year, as you can imagine. So it was nice to be able to see our states and our regions respond to this level of need that quickly arose given some of our challenges. And with this program, one of the things that we're always looking to measure is how many of the students are actually completing and are moving on with those skills that they can take and use with employers. 70% of Hoosiers that started a program in Workforce Ready Grant actually completed. So that was fantastic to see. So where do things stand today? This past year, we had a pretty big infusion of CARES funding through the Rapid Recovery period that we had here in Indiana. We still have about $1 million of that left. So if you know individuals or you are a business and you have individuals in your company that may benefit from accessing these funds or taking advantage of these opportunities, please direct them to nextleveljobs.org. Send them to your local Work Ones who can help them get connected and integrated with these resources. There's still funding left available through the end of the year here. So beginning January 1, we will receive our additional $3 million state infusion of funding to this program. But one of the things that will be a little bit different about this is we will see these funds being accessed more closely with our Work Ones. This past year we did some pilot testing to kind of identify, by sending individuals to the Work Ones and having that support through the education process, or by sending individuals directly to the training providers, who was seeing more success? Well, one of the things that we saw that was highly successful is our credential and completion rates among those individuals that were receiving that sort of wraparound support were much more successful than those who were not accessing those services. So that's one of the changes that you'll see to Workforce Ready Grant come January. You'll see our Work Ones getting involved and our local workforce boards getting involved more and more with this process. So we've talked about a couple of solutions here, or a couple of different things that are happening here now and are available in Indiana and will continue to be available. But one of the things that we often don't spend a lot of time talking about is what are the resources that we already have here, and what are we doing to help tap into those? Now, I will be the first one to tell you, yes, I work for the government, and I know that these programs have a lot of rules, and they can seem hard, but that's really how I see my job, is to help make these programs not hard to access for businesses and for Hoosiers. And so a lot of what I'm going to share with you today are ideas that I hope that you'll be able to take back to your communities and roundtable these ideas. Think about what's going on in your local city or your local county or in your region as a whole, and how can we use some of these tools to our advantage to really maximize the impact for our businesses and Hoosiers. So you may or may not be familiar with WIOA. It's our federal workforce program. It's the largest infusion of workforce dollars that come to our state for workforce. We had one of the biggest changes in legislation in 2014. Hadn't been changed since 1998, so a long time, 16 years. But one of the most significant changes that came about with WIOA was a more balanced approach to how we are leveraging the support to businesses and workers, right? We know that we can't just do one without the other. How do we make all of these boats rise? And so you'll see, since 2014, and as we continue to grow here with this legislation and we gain more traction, more and more you'll be able to see programs that really are targeted towards businesses and making sure that they are thriving as well. So the first one that we're going to talk about is incumbent worker training. And the reason that this one resonates so well is because we just saw on the previous slide that our employer training grant, if everybody was fully funded, we would beyond exceed the allotment of funding that was available. So we have a significant gap in the need of our businesses and what's currently available. So incumbent worker training is designed for that special purpose. So it's designed to meet the requirements of employers or groups of employers that are in partnerships in response to special circumstances. So, just a few statistics up here for you to take a look at. 79% of CEOs are concerned about the employee's lack of essential skills. We know this. 60% of employers believe that their current skill sets will be outdated very soon. COVID showed us that was very real. 46% of CEOs cite the significance of upskilling as their top strategy and priority. So we know that people are very focused on this right now. We know that there are significant gaps. What tools do we have in the toolbox to sort of address this? So this particular incumbent worker program is designed to do a couple of things. It's designed to help avert potential layoffs for employees. And it's designed to increase skill levels of employees so that they may be promoted within the company or create backfill opportunities. And I know that happens a lot, here in Northwest Indiana and throughout our state. So how does this program work? Incumbent worker training is delivered through your local workforce boards. There's a business matching component, which I think once we get to it and you see the business matching component, you'll be surprised on the small contribution that's actually required from the business for this. And then there's a few training participant eligibility pieces. So starting with the business eligibility, this is largely determined locally, and this is an area where, I kind of, tell groups of people that this is where you can kind of all get involved to help figure out, what does it mean to make sure that a business would be eligible for incumbent worker training. Obviously, with a finite amount of funds, you're attempting to target those businesses who are in the most need. There's characteristics of the participants that are going through the training. They're going to consider things like, are these executive level managers that we're looking to train, or are these frontline workers? Things like that. The relationship of the training to the competitiveness of the individual or the employer. So will this training result in a benefit for the individual, and will it also benefit the business as well? And then a variety of other factors that could be considered, again, with just the main goal of making sure that we're targeting those businesses who are in the most need and who may be most vulnerable. Okay, so now talking a little bit about the individuals receiving training. A lot of times we think about government programs and we think, well, there's probably about 40 different things that somebody has to qualify for in order to be able to access these things. And so I wanted to break it down to show you just how few things and how most people that probably would need to access these opportunities would probably be qualified. So for individuals, the employer must meet the fair labor standards of the employer-employee relationship. That's going to be, in most cases, a win-win. Have an established employment history with more than 6 months, but if a business happens to be training multiple employees, as long as a majority of the employees have been there more than 6 months, you can still add in those new employees or those folks who have been there a little bit less time. And then they have to be eligible for our WIOA services. And when we think about WIOA services, there's really 3 main components: 18 years old, citizen or non-citizen, or authorized to work in the United States, and then meet military selective service. We also look for barriers to employment, but as we're thinking about why somebody might be accessing incumbent worker training, it's likely because they are skill deficient. And so that in itself is that barrier to employment. And those are the kinds of things that help us to be able to access these programs and leverage them to our advantage to meet the needs that exist today. I've got a little note down here, just because as we talk about workforce in general, we do talk a lot about priority of service given to veterans, individuals who are basic skills deficient, maybe on public assistance and low income. It doesn't mean that those are the only individuals that can be served, though. It just means that those are the folks who we are targeting because they may be the most vulnerable and in need of those kinds of services. Okay, so now we talk a little bit about the business cost share and what this looks like. So for businesses with 50 or fewer employees, only 10% of the cost share is what's required. If they've got between 51 and 100, only 25% of the training cost is required. And then with 100 or more employees, it's 50%. But if you take a look at the matching contributions here, cash contributions, they can be fairly evaluated in-kind contributions. So space you're using at the business, right? Space and rooms or equipment that you're using to train these individuals can absolutely be leveraged for in-kind contributions. Wages paid to individuals while in training. I think you can quickly see that a lot of these kinds of forms of match would easily add up to the amount that would be required to meet that 10, 25, or 50% match, fairly evaluated in-kind contributions. So, while these programs may seem like they have a few hoops to jump through, they really are, if leveraged appropriately, they really can provide a really great benefit to businesses and the employees. So that's a little bit about incumbent worker training. Hold on here. We might have died. I think we died. We'll use the keyboard here. There we go. So now I want to move in to talk a little bit about layoff aversion. This is one that's used even more less frequently here in our state. But as we have experienced what we have with COVID, this is a good opportunity for us to use this as a prevention tool. When we think about layoff aversion, these are the words that sort of stand out to me. An ounce of prevention is worth a pound of cure. So, help us to better mitigate things that we know may be coming, and help us also respond to those things that happen very quickly. So what is layoff aversion? Layoff aversion is workforce services in the form of strategies and activities designed to prevent or minimize the duration of unemployment resulting from layoffs. So we want to take care of the business because we want the business to continue to thrive, and we want to take care of the Hoosiers that are working there because we want to maintain their employment or quickly get them upskilled to move them into new employment if that can't be sought. So how does this work for businesses? Layoff aversion, just like many of the other programs that we talked about today, is delivered through our workforce development boards and their work ones. And so I want to talk a little bit about some of the strategies and activities that are available. And by all means, I'm not sharing them all with you today. Again, I challenge you to all go back to your communities and think about the kinds of things that are happening, and think about the kinds of things that you may need to best support your business. And then how do we design that to fit within some of these programs here is really how we want to look at this. So some examples, funding feasibility studies. So, should we know that down the line we have a business that will no longer be here within 6 months to a year, feasibility studies could help us pay for and identify what the secondary, tertiary effects might be of losing that one business. Or they might help us identify, what would the cost benefit be to another business in our community to potentially buy out that business. Layoff aversion funds can actually help pay for those kinds of assessments, for us to help kind of uncover what some of those needs are. Economic transition and training needs. So, if we know that there's going to be a business that's going to be dislocating, we know that Hoosiers are going to be impacted, what kind of economic transition can we put in place? Is it training that those folks may need access to quickly upskill and be ready and available for the business next door? Is it some kind of other incentive or strategy that's used to respond to that business to make sure that as they transition, they can transition and maintain their workforce as long as possible? Another example here is the incumbent worker training, and we talked a little bit about that. But in many ways, if we find that one of the reasons a business may not be thriving is because they may not be as up to date with processes or the type of equipment or things like that, and that puts the business itself and the individuals that work there at risk. That's an opportunity where layoff aversion can come in and help to support the workers, to get them the training they might need, and then also the business, to get them the resources or the funding that they might need to keep them sustainable. So those are just a few. I've got a few more to share here. So managing reductions in workforce. So, if we are talking about large dislocations, what kinds of plans and resources can we put in place to make sure that those individuals are able to easily transition? A lot of times it seems as simple as just, this business is dislocating and there are a ton of openings over here, but we all know that sometimes that gap between where that individual was working and where that individual might go to work next, there may be a huge gap in skills available. And so, we take this moment when we're transitioning it like this to really assess those individuals and make sure that they're as prepared as possible for those new opportunities, so that when the businesses receive those individuals, they're receiving individuals that are going to continue to help their businesses thrive. And then conducting analysis and risk assessments. Maybe there's been a lot of dislocations in a certain area. What kind of risk assessments and analysis can we do or can we fund to help maybe understand what some of the effects of the suppliers of some of those businesses, how those were impacted? What are some of the other outlying businesses that might have also used the resources and what was the impact to them, so that we can start to see, what may come down the line by, an impact of just losing a particular business. So I've talked a little bit today about a lot of prevention, a lot of preservation, and really how we take these government programs, and we really maximize them to our benefit. So again, I hope that you take even a little bit of this back and you really think about, how this might be maximized in your community. And I encourage you to collaborate and connect, if you haven't already, with your local workforce boards to help you work through some of these solutions and know that they're available here above and beyond some of the initiatives that you may be more familiar with. So with that, I'll take a few questions and then I will pass it along here. So a lot of times we see some of the activities and strategies that I mentioned used together. So a lot of times it would be that funding feasibility study, and then along with that, funding to support maybe incumbent worker training or upskilling in some way to make sure that there is a second step in that process. Layoff Aversion pulls in a lot of other resources too. It accesses, taps into IEDC and some of other state resources. But absolutely, it's designed to work in tandem to make sure that there is funding to respond to what we find in that study. Yes.
Hi. Has there been any funding available for the high school level work programs or any of that such? Are you involved in that?
So when it comes to our high school programs, are you talking about individuals that are in school or graduating?
Well, perhaps there was programs that, the proper book training programs and things like that, where they were part of it, and then, for the school part of it, is the state working on any of those programs?
So I know that our K through 12 institutions are definitely, that's a hot topic of discussion, especially with some of the requirements that they've added within the last few years about adding in work experience and things like that. So it's definitely something that's on the discussion table. It's not a big focus at DWD and what we focus on. We spend a lot of time working with those out-of-school youth and focusing more on those adult populations. But definitely it's being discussed, and there are a lot of different opportunities available for those folks. All right, thank you so much for having me. Enjoy the rest of your afternoon.
Well, thank you very much, Allison. So what I heard there was we got all these great programs, but access to them is really through Lisa Doherty. Is that right? Yeah. So if you stand up, Lisa, so everybody can see it. And I'd love to see everybody's bright, smiley smiles, but there we go. That's better. So, but if you need any help with this, and think about some of the broader concepts there in terms of if your company's struggling to hang on to people, or if you are worried about having to have layoffs, or your business is in a tight spot right now from COVID or whatever, don't struggle alone. To reach out to Lisa and her team, and I'm sure they'll accommodate you in whatever way they can, right?
Yes, if I could just take a second, two quick questions. We do have local programs. We're very focused on youth. There are a variety of different, and when I say youth, in our world, that means, 16 to 24 years old, generally. So, please, I don't have cards for everybody in the room, but happy to get you connected with resources, absolutely.
Thank you. So, Allison didn't really tell you, though, so she came all the way up here to go to. She's a brewery, you can love her. So she came up to 18th Street Brewery, Zorn, Shoreline, and Burnham, right? Wasn't that them four? I mean, Burnham's got the good stuff. Oh, it's still afternoon. Okay, so plenty of time. But anyway, thanks for coming up. So our next Why Notter is going to tell us about our economy, and he votes from Horizon Bank. His name's Steve Skalka. He's a senior vice president and investment manager at Horizon. That's a community bank serving northern and central Indiana and central and southwest Michigan. He's a member of Horizon's Trust and Investment Committee and their administration committee and the officers committee. In his role at Horizon Bank, he's responsible for developing and implementing the direction of Horizon's investment division. In this capacity, he maintains a current awareness of changes within the wealth management industry, including new investment strategies, taxation, and wealth transfer techniques. Steve regularly performs analysis on individual equity and fixed income securities as well as mutual funds. Moreover, he helps develop and implement investment strategies that are utilized across Horizon's diverse client base. Today, Steve is going to discuss his views on the economy, as well as the equity market, fixed income markets, and provide a national economic outlook. And I'm sure after he gets done, if you have need a little help with your portfolio, you can just get him over in the corner and he'll give you some good stock picks. But anyway, he graduated from Purdue University with a bachelor's in accounting with distinction, and also a Juris Doctorate of Law. He graduated magna cum laude from Valparaiso University. So please give a big Northwest Indiana welcome to Steve Skalka.
Everybody hear me? All right, I'm all hopped up on my Golden Grams and ready to go. So we've got a slideshow. Tony's going to talk more about the economy. I'm just kind of setting the stage, which is just kind of what our forecast is for the economy, because it leads directly into what we see for equities, what we see for fixed income. As you can see here, you kind of want to focus your attention here on the United States. You've got 2019 economic growth measured by GDP, 2020, which of course, because of COVID, that's why we don't want to think about 2020. It didn't happen. We saw negative economic growth. Now we're seeing a big increase in economic growth. But the key is when you look at 2022, growth is still expected to be strong. But then after that, where do we go? We kind of go back to the trend pattern prior to what we experienced pre-pandemic, about a 2% growth rate. So that all has to be incorporated into our forecast for the equity market, into our forecast for the fixed income market. And, really kind of want to discuss, first off, why did we see that strong growth this year? Look at the economic stimulus that came across. Stimulus payments and income tax refunds distributed by month. You had $391 billion in April 2020. We still had negative economic growth, but let's face it, the economy was shut down. We had more economic stimulus payments in March of 2021. Think back at March 2021, what was happening? Everything was reopening. Shouldn't be a shocking surprise that the first half of this year was extremely strong. About 6.3 in the first quarter, about 6.7 in the second quarter. Preliminary estimates, however, for the third quarter, closer to 2%. We're seeing that slow down. You really have to understand, where does economic growth come from? This is a picture of the components of general gross domestic product in the United States. The key is 69% is consumption. We are a consumption-driven economy. Consumer spending is where it's at. So with that said, you're looking at the slowdown. What's going on with the consumer? Next couple of slides. Consumer spending faded as stimulus payments rolled off. The people that were going to spend the money, they got it, they spent it, it's gone. There's a slowing now. There was significant money that was directly deposited into people's bank accounts. They used it. They bought stuff with it. Why else are consumers slowing down? Virus anxiety. You've got the share of adults who are very concerned about COVID, and it's an inverted, they're in red. So in other words, if the concern's going up, the chart's actually going down. And you can see the direct correlation between concern with COVID and what's going on with consumer confidence. If consumers aren't confident, they're not spending. Direct correlation. So that's what we're seeing there. We saw a correlation with COVID. The Delta variant, when it started to build again in July, consumer confidence went down, spending went down as a result. Job openings, also labor and supply bottlenecks. Small business owners, who out there wants to hire more good people? Everybody, right? There's help wanted signs everywhere you go. What else are you being encumbered by? Shortages. This chart shows, basically S&P 500 earnings call transcripts and how many times shortages were mentioned in terms of being a drag on earnings. You could see it skyrocketed. You can't get things. And bottom line, if you can't build the product or provide the service, consumers can't purchase it, which is a drag on economic growth. So that's kind of where we are there. In addition to that, inflation is an issue. Inflation has been greater than 5% for 4 consecutive months now. We saw inflation just kind of hover around 2% for an extended period of time. We see heightened inflation. It's having a direct impact. In fact, if you look at the survey data, when consumers are being survey regarding what concerns them the most, inflation is up there higher than unemployment in the recent survey. So, inflation is on top of mind for a lot of consumers. Higher prices for everyday items. Gasoline, up roughly 73%. Coffee, 62%. How many of you are going to get more coffee at break now because you know how much more money it's worth? Cotton, 50%. Sugar, 26%. Put a little bit more sugar in your coffee. Corn up 18%. Used cars, 25%. And go past it. Have any car dealers here? Any representatives from car dealers? Unbelievable. You go through a lot that used to be filled. There's 5, 6 new cars out there. Most of their inventory is used cars. And that's because of the semiconductor shortage. Impacts consumer behavior, how people are impacted by these higher prices. They're buying in smaller quantities or big ticket items. Maybe they're postponing those purchases. So it's having a direct impact on that 70% of the U.S. economy, and which is slowing things down. Okay, from there, that kind of sets the stage. Our call is for slower economic growth, as you saw in the charts, as you saw in the information that we provided. What does that mean for equities, stocks? Equities, stocks, use those words interchangeably. A little bit later, we're going to talk about what does it mean for fixed income bonds. Use those words interchangeably. Equity. First thing you got to remember about equity is, what does it represent? It represents ownership in a company. Simple concept. Ownership. What is ownership? It gives you a stake in future earnings. If you think future earnings are going to be stronger, you're going to be willing to pay more for that stock, right? I mean, it just seems to follow. Slower economic growth, as we just talked about, is going to be a drag on future earnings. So it kind of flashing a little bit of a warning sign there for stocks because of that earnings, downward pressure. Regardless, U.S. equities amazingly resilient in the face of COVID, in the face of slowing growth. I mean, this isn't new news. This is things that have been developing over the last couple quarters. There's inflation, which we talked about. You've all probably seen the headlines regarding stagflation. What's stagflation? That's slowing economic growth with inflation rising. Higher taxes, or talk of higher taxes. That's a concern. How does that impact corporations? Higher corporate taxes are going to be a direct drag on earnings. Once again, direct impact on stocks. Credit issues, Evergrande situation in China. There was talk of credit contagion because nobody knew how bad that was going to be. Thus far, we've gotten through it. But look at that S&P 500 chart. Third quarter of 2020, things really still stunk back then, right? But look at the equity markets, not bad. Fourth quarter 2020, equity markets not bad. I mean, there's some fluctuation, but the overall trend pattern is up. First quarter of this year, tremendous. Second quarter of this year, tremendous. Third quarter of this year, other than the mid-September bump down, it's been tremendous. I mean, we're back off to the races again. So stocks have been doing good. Why are the stocks so resilient? We are strong believers that the amount of liquidity in the system, the amount of cash in the system really drives stock prices, and I think this chart really kind of shows that. M2 money supply, that's how much money is flowing in the economy. There's a direct correlation between what happens with the M2 money supply and what happens with the S&P 500. It really comes down to, you get a little bit more money in your pocket, you're looking for places to use it. You want to invest it or whatever, and stocks have captured a lot of that. Also, why so resilient? TINA. There is no alternative. Where do you go? So we're going to talk about a little bit later. Fixed income return prospects don't look too good. You've got rising interest rates and you got crappy yields. That's not a good recipe for a strong return. Our forecast for fixed income returns over the next couple years, next two years or so, probably 1 to 1.5%. Where's inflation? Inflation, as we saw on that earlier chart, has been the last three quarters has been over 5%. You're not keeping up with inflation there, so a lot of people are just migrating to equities because there are no good other alternatives. You look at valuations. This is a concern for us, though, because if you look at U.S. equity valuations, what's a valuation? Price divided by the earnings. So once again, the earnings comes into the equation, and if you look at it on a historical basis, you can see here, the diamond represents where we are. The purple bar represents the average. The gray represents the 25-year range. We're well above average. We're not quite to the top of the range, but you got to remember, 25 years, we're taking into consideration the dot-com bubble. So the valuations were a lot higher back then. We are seeing some more opportunity in terms of valuation, in terms of valuations in countries such as Japan. Europe is pretty much right around the average. Emerging markets just slightly above average. So at the beginning of the year, we actually pushed a little bit more of our investment portfolios into international stocks. Thus far, it hasn't worked. We didn't make a big move in that perspective, but I'm cheap. I like to buy things on sale. It hurts me to try to buy U.S. stocks right now based upon the valuations. U.S. large cap earnings per share growth. Going back to slowing economy, going to be a drag on earnings. You look at projections for most of the research shops that we follow, and what you're seeing is the same trend pattern over and over and over again. Here you've got Russell 1000 growth, which is U.S. large cap growth stocks. You've got Russell 1000 value, which is U.S. large cap value stocks, represented in pink. Growth is in blue. Just notice the trend pattern. Trending down. Earnings trending down. That's a concern for valuations. And if you keep on looking, Russell 2000 growth, Russell 2000 value, U.S. small cap growth and value stocks. Once again, general trend, follow the pink. It's a little bit more choppy, but the general pattern is trending down. Earnings growth is the expectation. If you follow the blue, a little bit more chop to it, but once again, somewhat trending down. That's what we're seeing there. Same pattern develops when we look at MSCI EAFE, which is developed international stocks, represented there in blue. Earnings per share, the estimates are trending down compared to the S&P 500. Everybody knows what the S&P 500 is. Once again, a representation of U.S. large cap stocks. Look at the pink, trending down. That's a concern. You then change gears. We look at emerging markets represented in blue and the S&P, which we already covered. But if you look at the blue, you can see once again, we're trending down. So that is a concern for us. And ultimately, what does weaker earnings growth mean? Weaker return expectations. We're not saying you're not going to get a favorable return, but we do expect returns to be below the long-term average, which has been 9.5% in the U.S. And over the last 12 years, or the last 10 years, it's actually been higher at 12.5%. We are seeing return assumptions closer to 6-7% over the next 5 to 10 years on an annualized basis. Annualized, that's key. That's smoothing it out. When you look at a 5-year number, you take them all, and it's roughly the average. Roughly the average. So you're going to have some years that are a little bit stronger. You're going to have some years that are a little bit weaker. But the key is to understand that from the research sources that we follow and based upon the information that we gather, it looks like lower returns are on the horizon versus average. But still, not bad. Not bad in comparison to the options. Fixed income. U.S. 10-year Treasury yield is really what we really kind of focused a lot of our attention on. First quarter of this year was about to rise in the 10-year Treasury yield rates, saw a significant increase. Second quarter, we saw a big dip. Third quarter was a mix of both. Things are all over the place in terms of yields. If you want a little bit more guidance in terms of where we are today versus where we've been in the past, think that this is a very good chart because what it does is it shows you the 10-year U.S. Treasury long-term bonds going back in time, going back to about 1960. 1980, we saw 10-year Treasury yields 14, 15, almost 16%. Look at where we are today. Look at the pattern. Why are rates going down so much? Think about how much the economy has transformed. Look how much more dependent we are on debt, which we're going to see in some future charts. The economy has really changed significantly, and the impact of interest rates on day-to-day life is more significant than it once was. And the trend pattern, as you can see from this, is definitely lower interest rates. Who is driving? Ultimately, Federal Reserve. Everybody knows who the Federal Reserve is. Chairman Powell, Fed Chairman. They're in control. They're in control of the fixed income markets. For all intents and purposes, it's been nationalized, in our opinion. Fed funds rate is the overnight borrowing and lending rate between commercial banks. It sets short-term lending rates. Whatever the Fed says that rate's going to be, that really all other short-term lending rates kind of follow in lockstep. So therefore, they're in control of the short end of the curve. Interesting situation, Great Recession. We were introduced to the concept of quantitative easing. Fancy word for direct market purchases. So they're out there purchasing fixed income securities. Why is that important? I think I've presented this every year since I've been here. It's the teeter-totter. If you know nothing else about fixed income, this is the key concept behind fixed income. You've got yield on one side, you've got price on the other. They move in inverse direction. When one goes up, the other goes down. If you've got the Fed purchasing fixed income securities, what are they doing? They're creating demand that wasn't otherwise there. What does that do? It drives up prices. What does that do to our teeter-totter? It drives down yields. They're in control of the intermediate and long-term end of the yield curve for all intents and purposes, or at least they have been. Look at the size of the Fed's balance sheet. Very, very telling, goes back to 2003. You can see at that point in time it was under $1 trillion. Great Recession, 08, 09, they introduced quantitative easing, went up to about $2 trillion, been steady growth since then. Look where we are today. Roughly $9 trillion in the Fed's balance sheet. Remarkable. Think about how all that buying that's going out there in the fixed income space that's keeping those yields low. That's really key in our mind. If you're in control of interest rates, what's your motivation? You're the federal government. You're running a U.S. national debt just under $29 trillion. Do you want to see rates go up much? Probably not. Probably not. That's not your motivation. More importantly, more than 50% of U.S. marketable debt is due in the next 3 years. You want to see interest rates go up significantly in the next 3 years? If you're going to have to reissue debt at higher interest rates? Probably not. Who would do that? It makes no sense. Weighted average coupon is 1.39 on an annual basis. That's about $500 billion in interest per year, based upon the current debt. If we see a doubling of that, so $1 trillion. Trillion here, trillion there, pretty soon you're talking real money, right? So, it's definitely in the government's best interest to keep rates low. In addition to the government, first off, if you just look at this or next year's budget, the CBO, Congressional Budgetary Office baseline forecast, 21% of next year's budget is supposed to come from debt issuance. Once again, you've got the historical debt, and you can see how dependent we are on debt today in the federal government. In addition to that, to set the stage, credit-driven economy, the federal government is highly dependent on debt. So is the consumer. Look at this chart. Total consumer credit owned and securitized. This does not include mortgages. But look at where, kind of in the 1980s, we started to slowly go up, and then in the 90s, we really put it into hyperdrive, and we've been growing ever since. Just under $4 trillion. If you add in mortgages, it ends up being right under $15 trillion in consumer debt. So does the consumer want to see rates go up too much when they've got all that outstanding debt and they depend on all that outstanding debt? Not the ones that have the debt. In addition to that, corporations are highly dependent upon debt. Percent non-earners in the Russell 2000 and the S&P 500, this is the one that shocks most people. Roughly 40% of the U.S. small cap stocks in the Russell 2000 do not have positive earnings. They do not make money. What are they dependent on? Cheap credit. Keeps them afloat. Once again, federal government, highly dependent on cheap credit. U.S. consumer, highly dependent on cheap credit. U.S. corporations, highly dependent on cheap credit. How can you see the interest rates going up that much when the Fed's in control? We don't think that they can. And that's really kind of our base case is they have some room to rise, but at a certain point, either the economy is going to push back on higher rates or the Fed's going to push back on higher rates. So, good for people that borrow, bad for savers, if you want to stick with fixed income at least. 10-year Treasury yield currently about 1.52. We think we can get up to about 1.9, maybe 2% before kind of like that amber light starts to flash. But once you get much past that, probably going to see that amber light flash. You're going to see some things break down on the economic front, or you're going to see the Fed step in some way, shape, or form. Inflation is kind of the big wild card. If we saw an inflation surprise, right now the Fed is in control for all intents and purposes based upon what we've been seeing over the last several years. Not to say they couldn't lose control. One of the ways they could lose control is through inflation, but we look at it from the standpoint of after the Great Recession, they tried to implement programs to increase inflation to no avail. Much of the inflation that we see today is self-inflicted. If it's self-inflicted, you can pull back on it. So therefore, even though we expect inflation to be above what was the pre-pandemic norm of around 2%, we think it'll probably kind of settle in around 3, somewhere around 3, which we believe is manageable. So with that, open it up for questions. Nobody came and pulled me off the stage, so I'm assuming I'm doing all right with time. Rocking. Those golden grams paid off. I tried to. I knew that was coming. What is cryptocurrency? Cryptocurrency, just think of the word currency. How can something be a currency when it fluctuates as wildly as it does? Look at other countries that had currency that fluctuated. They fail. It doesn't work. Do you want to have to look at your cell phone to determine if you want to buy a pizza based upon where cryptocurrency is today? Do you want to sell it or not? Really not a currency. However, it's an investment. But it's an investment as long as people support it. Why are they supporting it? A lot of it's just speculation. What concerns us about cryptocurrency is roughly 80% of cryptocurrency is owned by a small group of individuals who ultimately, I like a little bit more control than that. And in addition to that, you're seeing a crackdown on cryptocurrency from regulators. India's crackdown. China's crackdown. There's talk in the U.S. about introducing a U.S. crypto dollar. Let's face it, one of the reasons we could be a creditor or basically a debtor nation, I mean, ultimately we can have that much debt, is because the U.S. dollar is the world reserve currency. Crypto is a threat to that. So at some point, we think the U.S. government's going to probably have to step in with its own cryptocurrency. Not to say you can't make big money there, but it is speculative. There was a representative at J.P. Morgan that I think said it best. If you're looking at putting it in your investment portfolio, you first need to identify what's your risk pool and how large is that risk pool. And if it's only 5% of your portfolio, crypto should be in the risk pool. So you could keep it in the risk pool, keep it as one of the risky assets, but don't lose track of what your risk pool is. And I think because of the wild gyrations in the headlines, people will adjust their exposure to crypto and other riskier assets based upon the hype. You need to define your risk pool. And I think that's probably the best advice I've heard in that space. Not saying it doesn't have a place in a portfolio. Some folks are using it as an inflation hedge. Better than gold. Look at gold. What's gold done over the last 9 months? It hasn't done too much of anything. So I think it has a place in a portfolio, but define your risk pool and don't let the hype make you go above what that risk pool is within your overall portfolio. Long-winded response. Yes, sir.
Your charts at the beginning kept up. So you indicated 22 and 23 are going to be really well, and then 21 and 22 will be well, and 23, 24.5 not so well.
Yes, sir.
Can you talk about why that is, and also is that affected by the supply chain right now? It's so squashed, getting worse. Can you talk about that?
Ultimately, I think the key is that we're going back to the norm, which was about 2%. That's what we're seeing across most of the research shops that we follow. They're looking at a lot of the supply issues are going to go away. That's probably why we're still seeing a decent 2022, because that's when it's expected to happen. And let's face it, in terms of inflation too, the best cure for inflation is higher prices. Why? Because you get more people coming into the market because they want to take advantage of those higher prices to make money. And it ultimately takes care of the higher prices because of the supply and demand continuum. So We believe that ultimately, next year looks good because they expect a lot of that supply chain and labor issues to go away. And then after that, there's really no driver. There's no driver to keep it above that 2% growth that's been identified yet. Now, granted, we're in a world that's largely influenced by government policy. Everything we went over could drastically change through government policy next week. You have to be nimble. When people are coming to us, we have valuation concerns, yeah. But then again, we don't really like fixed income too much, so we're telling people, hedge your bets. Don't just set up your portfolio for one outcome. Set it up for multiple outcomes. Smooth it out. I've been doing this for 19 years. I attribute that to the fact we don't take big bets. We hedge our bets. The investment manager is the first one to go when things go south. And that's just the nature of the beast. I hide out a lot, though, too. So I get there before the CEO, and I try to sneak out when he's not looking. So, but if you take big bets, things go south, you're looking for a job. So, a lot of it's self-preservation. And, there's some clients out in the crowd. They know how we manage money, and, we're not trying to shoot it out of the park. But, just steady over time. That's where it's at. We're not the ones that you're going to talk to your friends at the cocktail party about how we just blew it out of the water. But you know what? You're not going to be a greeter at Walmart at the end of the time either. So at least nobody has been yet. So any other questions? Yes, sir.
Why has the equity market been pretty good during these turbulent times? The stock market has gone up, and during these turbulent times, I don't understand that.
It really, to a large degree, comes down to, there we go. Oop, there we go. Combination of two things. It really comes down to all of that money that's in the economy, it needs to be put to work. And you look at all of that money that needs to be put to work, it needs to find a home. You combine that with the fact that fixed income doesn't look very attractive. We have got a fair number of clients that have been fixed income, that are now exploring stocks. Now, how are they exploring stocks? They're exploring stocks with dividend-paying stocks. Vanguard Equity Income Fund has about a 2.3% yield. Where can you get 2.3% in traditional fixed income without getting crazy with risk? Either interest rate risk or credit risk. You can't. It doesn't exist. Even though historically stocks are more volatile, if you look back over time, within 3 years, typically max, even if there was a significant sell-off, stocks were back where they are. If you treat a dividend-paying stock like a hold-to-maturity bond with that mentality, it's a good place to get more than 2% yield. So we're seeing a lot of traditional fixed income investors move over to equity with that mindset, and we've promoted that in many instances, and it really kind of comes down to the whole TINA concept. Sure, we can lock in a CD, and if we're getting real creative, right now there's a 10-year CD special. Who wants to lock in for 10 years? It's a 1.15, but it has a 90-day early withdrawal penalty. That means if you get out, you only pay 90 days interest. If we hold it for 12 months, we get a 0.75. Current rate's 0.25. That excites us. That's pathetic. Right? As a number, it's pathetic. But comparatively, that excites us. I go home and tell my 9-year-old about that. So that's really it in a nutshell. But see, that's the thing. You need to hedge your bets. For accounts, maybe put a little bit in there, but also explore the equities. Because if equities go south, you got that to cushion the blow. But if fixed income doesn't keep up with inflation, at least you still have the possibility of growth through the equity. And over the long haul, based upon history, that's where the opportunity's been. And when we're looking at 5-year, 10-year return projections for equity, even though they're 6-7%, fixed income's 1.5. You love the fixed income when equity goes down. And that's why you need the ballast. But you need to define your risk parameter. You need to define what's the asset allocation that I'm comfortable with? What's the level of volatility I'm comfortable with? What's the level of risk I want to put in my portfolio? And don't let the hype skew that, because that probably doesn't change with most people. And typically when they want to change it, it's the wrong time. When do they want to change? When do most people want to increase their equity? When equity is doing good. When do they want to decrease their equity? When equity is doing bad. I like to buy on sale. That's what you want to do. Look at energy. Energy sucked wind this is on tape, sorry. It stunk last year, right? There was one point in time, crude oil contracts were negative. You had to pay somebody to take crude oil. Remember that? And it was a blip in the radar. It was very short-lived. Energy, top performing sector in the S&P 500 this year. When things look the worst, kind of assess the situation. But you know what? Typically, history shows that's when you buy. But right now, everything, unfortunately, is looking a little bit good. And if you look, I'm talking too long. I know, just give me the hook. But if you look at the technical indicators are still telling us the equity's got some room to grow because people are willing to accept that higher valuation because the lack of other alternatives. So probably no time for any other questions.
Great presentation.
I took it anyway.
I did learn a couple things, though. One was, instead of investing in cryptocurrency, I think I'm going to go to the casino and invest in Northwest Indiana. That's one. And then we have to-go cups, coffee, take home a little piece next year with us. No sugar, though, because it's 25% higher. It's bad for you. Anyway, so thank you, sir. Well done. Thank you, Steve. All right, our next why notter is Peter Novak. He's the CEO of the Greater Northwest Indiana Association of Realtors. It was formed in 1995 and represents more than 1,800 members in nearly 500 offices in Lake Porter, LaPorte, Jasper, Newton, Stark, and Pulaski counties. Sounds like the same footprint as the Forum and the IEDC. Dyer helps members be productive in their business and achieve ongoing profitability through targeted education and ethical and professional standards. In his role as CEO, Peter is responsible for all day-to-day management decisions and for implementing the company's long and short-term plans. Today, Pete is going to provide you with a comprehensive overview of the real estate market in Northwest Indiana. I hear it's red hot, so very anxious to hear your comments, Pete. So let's please give Pete Novak a warm welcome from Northwest Indiana.
Just forward button right here? Yep. Okay. Thank you. Can you guys hear me okay? Thanks. Thank you, Don. Red hot, Don. Actually, I'm here to deliver some very bad news to you guys. The market's crashing. The bubble is bursting. Prices are about to go skyrocketing down. I actually think they are already. So I have a couple realtors that are in the crowd right here that can assist you in selling your home if you want to get rid of it and cash out high. So we have Nancy Frigo, Susie Wireman, and some others there. That's not the case, although if you read some of the headlines, you might think that. You read a lot of different stuff on the internet. I know during the pandemic, a lot of people were predicting the housing market was going to crash, and I'll tell you, you could have convinced me. I think we were preparing for that. But even since the pandemic, I hear people saying, okay, well, it didn't crash during the pandemic, it's going to crash during 2021. And then here we are at the end of 2021, and we're going to go through it a little bit. And then, I hear the same thing like next year, it's going to come crashing down. There's a little bit of the truth to that. The market's changing a little bit, but we're going to go through it. We're going to try to paint a better picture for you guys and let you see for yourself, and you guys can draw your own conclusion on that. So I thought I'd start out. I always like to start out by giving a little bit of history, or a lot of history, if you will. And I like to always tie it to what was good times, which was kind of the early, mid-2000s. Of course, we all know what happened, with the recession. And that wasn't a housing crisis, by the way. That was more of a mortgage-backed security banking crisis, if you will. But, of course, housing was affected by that. And then we've been on a pretty good run since then. That really had nothing to do with the pandemic, but certainly got accelerated during the pandemic. So we're going to talk about that a little bit. So as Don mentioned, we cover a 7-county area. We cover Lake Porter, LaPorte, Jasper, Newton, Stark, and Pulaski counties. So it's a pretty diverse area for us here in Northwest Indiana. We get everything from the urban, suburban, and rural in that footprint. And we sell approximately, well, if we're looking at, around 2005, 2006, which was our peak prior to the market turning. We sold in that 7-county area about a little bit over 10,000 properties. And then as you guys can see, the market really started to turn for us right around 2006. Prices started decreasing in 2007. It takes a little while for consumers to catch on to what's happening with the marketplace. And then as you guys can see, of course, where's my pointer there? Okay. Yeah, it jumped down pretty substantially through the recession, which is obviously no surprise. And then we were hovering pretty low there for a while, 2009, 2010, 2011. Those were pretty tough times for, I know for a lot of our members, but just homeowners in general and people in general just were struggling with the economy. And there was a lot of heavy, federal subsidies that were occurring at that time, lots of different stimulus packages. I know some of those stimulus packages certainly had a positive impact on the residential real estate market, in my opinion, and others, it would have been a lot worse, of course, if we didn't even see some of that. But if you guys have noticed, really starting around 2012, we started a pretty good uprise there, and it really didn't stop. It's been going on. There was a little bit of a blip there, I think, between, I think it was 2013 and 14, where it got a little flat, but it started to jump up pretty exponentially. So as you guys know, 2021 is not over yet, so what we're showing for 2021 is just projected, but again, it's been a pretty strong housing market, and I think I want you guys to just kind of take a mental snapshot of this, because I want to compare a little bit later into the presentation the numbers between what was happening in 2005 and 6 and what's happening in 2019, 20, and 21. Just take a mental note that we're selling more properties right now than we were during that time. And I came up here joking about the market crashing, but the big theme of what is happening in residential real estate right now is inventory, and so we're going to get into that just a little bit. This next slide, again, talks about a little bit about prices here in Northwest Indiana. First off, I think I'm probably preaching to the choir here, but you guys all know that Indiana in general is a low-cost state. It's a low-cost state from a housing perspective. And so, when you look at our median selling prices, and I'm going to talk a little bit about the rest of the state of Illinois, and national, and how we compare. And we'll talk a little bit about the Move to Indiana campaign and our efforts to get people to notice us here in Northwest Indiana. But our previous high, as I mentioned, was 2007 before the recession. The median selling price at that time was a little bit under $130,000. And what you can picture on that is just a home that's generally 1,900 to 2,000 square feet, 3-bedroom, 2-bath. Again, I mean, of course, houses are all different sizes, bedroom count, but when we're talking about median selling price, that's generally the house you can picture. And that would be true nationally as well, so it's not different here in Northwest Indiana. When they're talking median selling price nationally, you're really talking about the same type of house. It just matters where that house is at. Again, during the recession, of course, prices dropped, and that's one thing to notice too. When we dropped, we didn't drop nearly as much as a lot of other markets did. A lot of those coastal markets, those that are near water, or some of those hot markets like Las Vegas and things of that nature, I mean, they were plummeting pretty dramatically. They were probably also, rising pretty dramatically before that happened. But being a low-cost state here in Northwest Indiana, we didn't really see the huge upswing that first time, and we didn't really see necessarily a huge downswing during that. Nobody ever likes to see their house value go down, but again, I think we were doing better than a lot of those other areas, and again, that just had everything to do with us being a low-cost state in the first place. But that surely has not been the case, especially the last couple of years. So I can tell you that the year-to-date median selling price for that same home that we talked about in Northwest Indiana is about $210,000. So it's a pretty huge upswing. We're talking almost an 80% increase from where our low was. And that really is the issue right now. Prices are rising. We're seeing in some years double-digit increases in home values. And it's not a Northwest Indiana thing. I mean, that's a national phenomenon. And again, it has everything to do with inventory. I'm going to show you some of those inventory numbers here very shortly. So Month supply of inventory. So this is one of the slides that we track, or number of the numbers that we report, and it talks about really just supply and demand. Month supply of inventory refers to the number of months it would take for the current inventory of homes on the market to be sold given the current sales pace. So I only go back to 2014 for these next set of slides because that's really when we started tracking inventory locally. I wish I could go back further. I think it would paint even a better picture, but that's just all the data we have. So one thing that we report, again, is month supply of inventory, and I could tell you that a normal market, a balanced market, would show somewhere of around 6 to 7 months supply of inventory. That would indicate it's not necessarily a seller's market, nor is it a buyer's market, it's a balanced market. That's really kind of where we were around 2014. It was a little bit higher than that. Again, remember, we were coming out of a recession, and for a very long time, it was a buyer's market, not a seller's market, but it did start to balance out. And I know everyone's talking about like the inventory issue right now, but the one thing about it is it wasn't from the pandemic. It got a lot worse during the pandemic, but we've really been going through a downward trend in inventory since 2014. That's a 7-year run at this point. Inventory has been declining for almost 7 years. So as you guys can see by this graph, we were right around 7-8 months supply and trending all the way down to really at some points during this summer, we were less than 1 month supply of inventory. So you're talking about not only a seller's market, but an extreme seller's market, a very imbalanced market. Believe me, I'd much rather have an imbalanced market this way than the other way, where we had way too much supply and no demand. But any kind of imbalanced market makes it tough for certain segments of the market, and we'll touch on that a little bit. But one other thing to notice, too, about inventory, you're going to see this in the next couple of slides, is that you see the peaks and valleys, and sometimes people think it's a myth that during the warmer months, more houses come on the market, more sales occur. It is not a month or a myth. You could just look at the data and tie them to the warmer months, and you're going to see that during the warmer months, absolutely more homes come on the market. It generally leads to more sales, and in the colder months, you don't see as many homes come onto the market. So, again, the total number of homes for sale. I asked you to take a mental snapshot of that very first slide that I showed that was talking about the total number of homes that we sold. One amazing thing, I think, when you think about this market right here in 2021 is that we are selling, again, more homes than we've ever sold in Northwest Indiana, but we're doing it with almost virtually no inventory. So what that means is, of course, that almost every single home that's priced appropriately is selling very quickly, and we're going to talk about how they're selling, like the competitive bidding wars that are occurring for the sale of these homes. But I want to make note that, again, I talk about month supply of inventory. I refer to this all the time. Back in 2014, during the summer months of 2014-15, we had close to 6,000 plus homes for sale on the market here in our 7-county area. I would say that we can't show the data before this because we didn't track it, but just from my recollection and memory, it was probably very similar, where we're always kind of traditionally around that 6,000-7,000 homes for sale. But again, as I mentioned already, here in 2021, there were points in times that we were under 1,000 homes for sale. I think it was 600 or 700 total homes for sale in a 7-county area. So imagine being a buyer who has all these boxes that you want to check, and it has to meet all of your criteria, and you just have virtually nothing to choose from. And so when you find something, believe me, and a lot of people that buy real estate, they're not doing it because they want to. A lot of them are doing it because they need to. There's certain situations driving the fact that they're purchasing a home. It could be that job relocation. It could be that fact that they have a growing family, or they need more bedrooms, whatever the case may be. So it is definitely tough to be a buyer right now. This graph right here, this talks about new homes for sale per month. It's just kind of more of what we were just showing you from an inventory point of view. It just shows you on a monthly basis the number of homes that were for sale at certain points of times. And again, just the whole theme of what you're seeing is just that it's been a downward trend, that the number of new homes that are coming onto the marketplace just over that time period became less and less. One thing to note in terms of what we're seeing recently, and this is what I meant about the market kind of turning a little bit. That needs context when I say it that way. But you can see that the number of homes that have been coming onto the market during this past year has been more than it has been for the prior several years. So it's an indicator that the market is softening just a little bit. But again, I emphasize just a little bit because it still is an extreme seller's market when you really take a look at things. Now, this is one that I get a lot of comments on when I show this to individuals, but and this is a little bit misleading. We titled the slide "percent of the original list price." So what that should mean is, and I'm just going to simplify numbers here for you. If I had a home that went on to the market and I originally listed at $100,000 and it sold for $95,000, then it would be 95% of the original list price. But really, the way we track the data, it just refers to the last list price. So let's say we listed a home for $100,000, we revised the price, which isn't happening much right now anyway, but we revised the price to $98,000, and then it sold for $95,000. We're gonna take the last price that we had, and then the selling price, and then use that as the percentage that we refer to. So one thing to take note of is in a normal market, you might see that fluctuate again, depending anywhere from as low as 90%, upwards of 95%. I would say that based on historic data, that's typically the range. I mean, you all understand it's just common sense. You can ask what you want for a property. That doesn't mean that's what you're going to get for it. There's usually, in normal times, there's usually a negotiation that occurs, and then you, as a seller, you'll settle for something less than what you're asking for, and the buyer feels good about that because they're getting the property for less than what you're asking for. But that is not what's been happening during the last couple of, really the last year specifically during the pandemic. We're seeing properties sell for higher than what the seller is asking for. I mean, typically what's happening is a seller lists their home, they put it on the market, they might have 20 showings over the weekend, and then they might field 7 or 8 offers, and those 7 or 8 offers, the seller's going through, and some of those offers are for more than the asking price, or the seller might say, hey, submit your best and highest, and then there you are, you're into a bidding war as a buyer. And unfortunately, given this marketplace, buyers are desperate, and so you can see there was points in times that properties on average were selling for more than the asking price for the entire market. Now that's cooled off since then. And if I showed the very latest data, which I don't have represented here, the very last month's data, that it's dipping even lower. And that happens a little bit during the colder months. Again, we're getting in October anyway, so that kind of happens a little bit, but I think it's also a sign that we're seeing a little bit more inventory. We're seeing some buyer pushback a little bit, and some of it just is an outright affordability issue, which I'm going to show you some price points and things of that nature that talk about how the market has shifted from a housing affordability standpoint. I mentioned move to Indiana. So I don't know, it's hit or miss with people whether they know about this campaign. It's something that we've been doing for a couple of years now, and first off, I want to thank some of our original partners in the Move to Indiana campaign, the South Shore Convention and Visitors Authority, the Northwest Indiana Times, Centier Bank, Ganayer, and then NIPSCO were the 5 founding partners, if you will, on the Move to Indiana campaign. But of course, we brought on some other partners along the way, including some of our municipalities that sit on that border area. And really what it is a digital advertising campaign, and that's why I say a lot of people in Indiana don't even know about it, because if you're seeing the advertisements, it probably means we're wasting our money, because you're not really who we're trying to attract. We're trying to attract the people in Illinois. So really, when I say digital, it's like an ad that'll pop up on your smartphone if you give any indication, and this is over my head and all the algorithms and how that stuff works, but essentially, if you probably even just say, I want to buy a home, and you're in Illinois, then an ad's going to pop up on your phone that says, hey, you should maybe consider moving to Northwest Indiana. So it's not, again, that's not something new either. We've been having people from Illinois come over to Northwest Indiana really for decades. But I will tell you, it's definitely gotten worse from an Illinois point of view. I think it's a variety of reasons. The struggles that they're going through as a state, of course, I think are a lot of it. But I think a lot of it, too, is just us getting potential home buyers to understand We're not some cornfield that's, way farther than a lot of the popular communities that are in Illinois. I mean, if you really look at some of the commute times, and Mike Nolan will be up here, I think, to tell you that here in a little bit, some of the commute times from some of the more popular areas of Northwest Indiana are the same or even less than what they are in some of the popular communities in Illinois. So to me, it really is just getting them to pay attention to us, because once they do, we don't even have to give them more reasons. I mean, the reasons, honestly, they sell themselves. If they even start to look at a home in Northwest Indiana, they're going to see the bang for buck that they're getting versus Illinois. And that's not even considering other things like property tax, sales tax, and all that other stuff. It just simply has to do with how far do I got to go to my job, which that's changing too. We're going to talk about that with all the remote work. But it also has to do with the fact that, wow, I can get a home that size for that price. It's just a huge difference. So. And actually, I forgot to comment on that. I mentioned the median selling price in Northwest Indiana is $210,000. The median selling price in the Chicago metro area is close to $300,000. If I excluded Chicago, because sometimes that might sway the numbers, and I just said, okay, what's the median selling price for the entire state of Illinois? It's close to $250,000. So that's still $40,000 higher than where we're at in Northwest Indiana. And if you actually look at the median selling price from a national the national numbers, it was $352,000 in September, this very last month's data. So we're considerably cheaper here in Northwest Indiana from a housing standpoint than we are on the national average, and even to our neighbors to the west in Illinois. So these next set of slides might be a little confusing, but what I tried to do here was just give you an idea of what's been happening actually during the pandemic. So we're using 2019 as a baseline. Again, 2019 isn't a normal year from a historic perspective because, again, we're in a very one-sided market, but it is pre-pandemic. So this just kind of talks about what was happening during the pandemic. Again, what you're going to see is red is 2019. And I'm sorry, I have like the clicker and like the red dot going at the same time here, so I don't know how to fix that, but just bear with me here. So 2019 just kind of shows you this is the number of homes sold per month. And what you're going to really see is that in 2019 or 2020, we started off the year a little bit better than what we were doing in 2019, and that's no surprise. We're just year after year for the last 7 years have been building on the prior year. But you can see very clearly what happened during the pandemic. So, again, real estate doesn't happen instantaneously. There's generally a couple of months between when, the seller and buyer come to an agreement, and then, of course, financing takes place and the home closes. So I could remember very clearly during that time talking to our group about what was going to happen during the pandemic, and I think this is probably true of any industry, but I know I could tell you for sure we were preparing for the worst, and I would have lost a lot of money betting what would happen during the market during that pandemic. And it did happen for a couple of months. You can see that the numbers shot down, but I will tell you it was a very brief pause, because after that, it went crazy. I mean, literally just went crazy. And you can actually see the end, starting in May, we started to jump back up. We started to pass what was happening in 2019, so we came out of that pause in the pandemic really quickly. And then this is the part, if you look at the end of 2020, there were some things happening that don't typically happen towards the end of the year. Again, when we get toward the colder months, that never really happened at the end of last year. The market just stayed pretty hot through the end of the year. And then when we jump into 2020, 2021, you can see that we've been, for the most part, slowly outpacing what happened the prior year. But because 2020 and that part of what was happening with the pandemic was so hot, we're actually seeing that for this portion, comparing 2021 to 2020, that 2020 actually is outpacing the second half of what's happening this year. And so I get asked from some people, does that mean the market's really turning? And I mentioned it softening a little bit, but I think it has more to do with the fact that we're going to look back at what happened during the pandemic and just realize it was just really unprecedented and something probably most people wouldn't have predicted. And it was just historically strong numbers that we don't typically see towards the end of the year. Same thing with median selling price. Again, this is just going to talk about where we were for 2019. It's just kind of showing you a little bit more of the same data that I was showing you on the first couple of charts, but you guys can clearly see that this is 2019. that 2020 during the pandemic just really was outpacing 2019. So while sales did pause for a minute, it didn't necessarily have much of an impact on prices at that time. And then, of course, during 2021, as I mentioned, the market's really been going crazy. So just another way to graphically look at what's been happening with our prices here in Northwest Indiana. And again, same thing with new listings. That's really the struggle, as we mentioned, is just really getting sellers to want to put their homes on the market. You're just going to see very similar numbers in terms of sellers and their activity over the last 3 years, outside of what happened during that brief pause during the pandemic. And you can imagine being a homeowner, learning about the virus and the effects that it has, and you don't want strangers in your home. So that's really what happened in terms of sellers wanting to put their homes on the market. A lot of them might even pull their home from the market at that point in time. Certainly anyone that was thinking about selling just probably put a pause on it for a couple of months, but it did not last very long. And one thing, I think all of us in our different businesses, but I can tell you that real estate adapted pretty, I guess I'm proud of the way that real estate adapted during that time, because I saw our members, the title companies, the lenders all being very creative on how to get business done, but of course try to adhere to what was happening with the CDC's guidelines and all of that stuff. So you were seeing things like mobile closings and all kinds of stuff happening. People were doing deals like out of their car and all kinds of crazy stuff. So it was pretty interesting, to say the least, and probably in some ways has forever impacted our business. Where I'm not saying we're still doing that out of cars and things of that nature, but I know if we had to, again, we could very easily, and everyone's prepared for that. And in a lot of ways, just like with remote work and stuff like that, consumers are doing business, and a lot of our real estate-related companies are doing business a little bit differently as well. So this, again, I'm going to skip through this a little bit because I know we're getting a little bit short on time, but this is just a little bit more of the same. It's just talking about the total number of homes for sale, just reiterating some of the information that I mentioned, that, as you can see, most of this year during 2021, we've had less than 1,000 total number of homes for sale. So again, think about the fact that we're selling more homes than we've ever sold here in Northwest Indiana, and we're doing it with virtually no inventory. So I think that's pretty amazing. These slides right here, this talks about what prices have done in certain price points in our market. And so these are arbitrary price points. I guess I consider 0 to 150,000 what you might see from buyers such as first-time home buyers and things of that nature. I can tell you that when you look at this price point right here, number one, if you look at the graph on the right, you're going to see prices have been rising pretty dramatically. And MSP, by the way, is just a reference to median selling price. But really, the part I think I want to focus on is what's been happening with the total number of sales in that price point. And so when I look at this slide right here, 0 to 150,000, I could tell you that in 2015, we sold a little bit under 10,000 properties, as I mentioned, before, and the total number of homes that sold in this price point used to represent in 2015 about 55% of the market. So more than half the homes that sold in Northwest Indiana in 2015 sold for less than 150,000. I will tell you that in 2020, it's about a third. It's only about a third. So 1/3 of homes that sold in Northwest Indiana in 2020 were less than 150,000. So if you're a first-time home buyer or somebody that just doesn't have a lot of income and you're trying to get into trying to become a homeowner, and you're barely able to even do that in the first place, and then here you are trying to buy a home and find out you have a ton of competition, and not only that, just the house that you're looking for just doesn't buy you what it used to, and so it's a huge issue. It's one of the main issues that we're having when you're talking about an imbalanced market like this, is particularly for first-time home buyers. It's just a really tough market to be in. So a little bit more of the same. Again, I won't quantify these, but just, again, when you look at the total number of homes that are selling for 150,000 to 250,000, we were kind of a little bit under 3,000 in 2015, and now that number represents almost or maybe a little bit more than 4,000 of our total sales. So again, really all you're seeing is what I've been saying to you, is that there's just more homes selling for a higher price point, which again leads into the whole affordability issue. I'm going to jump to this one. This is homes sold for $400,000 or more. I used to think this was an expensive home, but I'm not sure I could really make that claim anymore, given the way prices have risen. So sort of that same comparison that in 2015 in Northwest Indiana, the total number of homes that sold for $400,000 plus was a little bit under 300. I think it represented about 3% of the market. So 3% of all homes that sold in 2015 were for 400,000 or more. I can tell you that's closer to, I think, 8 or 9% of the total marketplace right now. So almost 1 in 10 homes that sell in Northwest Indiana are selling for $400,000 plus. So again, just speaking more to the fact that prices are just rising dramatically, and affording a home is not as easy as it used to be. So these next set of slides real quickly, and I'll go through these pretty quickly, is these are national numbers. So the reason we're reporting them is this isn't information we necessarily have locally, but I still think it'll help you kind of just get a good understanding of what's happening in the housing market. This is all cash sales. So one big change that's happened from before the recession, and then it didn't really happen much during the recession, but since we've come out of the recession, one thing that we're seeing, it's kind of the new normal now, is that you're seeing that this slide represents the total percentage of cash sales. And these are national numbers. So what this graph is showing you right here is that at certain points of this past year, 25% of all sales were all cash sales. So imagine being a buyer. You're typically, unless you've done very well or you've been very fortunate, you're going to have financing when you're buying a home. So you're out there, you have less than 1,000 homes to choose from. You already know you're having bidding wars with competitors, but oh, by the way, some of the people you're having bidding wars aren't typical consumers. A lot of them are investors, they're hedge funds, or things of that nature. So you're seeing a lot of investment money coming into real estate, and they have the resources to take advantage of this marketplace where a typical consumer does not. So 1 in 4 sales are cash sales right now, and that, again, that's just more information that speaks to how tough it is to be a buyer right now when you're putting in an offer on something and it says, and you might have great credit, you might have a good down payment, you might have very standard financing, and then the seller's going to choose something that, of course, and as they should probably, is just going to be the least path of resistance for them, and that's really what's happening a lot right now in this marketplace. So. Again, I mentioned what's happening at the national market. The median selling price on the from the national standpoint is over $350,000. So what that is doing is forcing a lot of people out of the home buying market and forcing them into the rental market. And I've heard some people make that comment before where they've said, well, I'm not going to buy a home right now. I'm just going to sit it out. I'm just going to rent. Well, unfortunately for you, or for those that think that, there's not much relief on the rental side either, and we'll talk about that a little bit too. So what this next graph refers to, again, national numbers here, are apartment vacancy rates. So what you're going to see is, typically, and it's been this way for a while. Again, as I mentioned, we've been in an inventory shortage since 2014, so this isn't necessarily new. But from what I understand, a typical apartment vacancy rate is around 10%. And for, again, for the last 5, 6, 7 years, it's been much less than that. So if you're a renter, it's the same situation as if you're a home buyer. You just have less to choose from. So it's supply and demand, and what, of course, that ends up doing is driving rent prices high. And so there's just not much relief on the rental side. I think you can go look at the data, and what you're going to find out is that it's historically high as well. So just as we're at historic highs in pricing and sales for home buying, the same exact thing is happening with rents as well. And so one thing I don't have an answer for, and I got asked this before, is obviously this dip right there had to do with the pandemic. I'm not sure exactly the reason behind that, or, of course, it had to do with the pandemic, or what those exact reasons are, but I can tell you for 2021, since that happened, they've shot up dramatically. So, and then one other note too, just with respect to what's been happening with the pandemic, is we're seeing a big increase in vacation home sales. And so I think the explanation for that is it has a lot to do with what's happening with remote working, and when you can work from anywhere and work remotely, and you're apprehensive about vacations and travel anyway, just what's happening with the pandemic, what you're seeing is a lot of people just putting their money into vacation homes where they're buying somewhere where they'd like to be, or what makes them happy to be there, and they can do their work right from there. And so you're seeing a pretty huge jump with what's happening with vacation home sales as well. So that's kind of what's been happening. We're not big. I mean, we primarily do residential. If you have a real estate license in Indiana, there's no distinction between residential and commercial, but they are different animals a little bit, so we get a little bit of crossover. Our MLS is geared more towards residential sales, so we don't have a ton of data on commercial sales, but I did just want to read a little bit, some comments from our national association about what's been happening in the commercial market. So this was just this past, or in September, the National Association of Realtors made these comments about the commercial market. It said, amid an improving economy, the demand for commercial real estate continues to recover, but the recovery is uneven across property types and geographic markets. There's a strong recovery in the multifamily, industrial, and retail property markets, while the recovery has not been as robust in the office and hotel property markets. I think that's understandable, again, given what's happening with the pandemic. Office commercial market is not good at all. It's actually doing better. I've seen a couple of recent reports where they say it is improving. So for all you people remote working, your employer might be thinking about getting you back in the office place. So I think that's what's been happening a little bit. And then, of course, the tourism market has been pretty tough for the last couple of years as well. And so, again, in the last comment, just with respect to workers returning to the office. Just a little bit of a forecast. I'm not an economist. I don't ever pretend to be. So we just report on what we've seen. In terms of any forecasting, we generally refer to the economists that we follow. And one of the main ones we follow is the economist for the National Association of Realtors. So what they're really predicting is that interest rates will be higher in 2022. That's going to certainly soften demand a little bit. And that might be okay, again, with the rising prices the way they are. We're eventually going to see a balance. It'll start to balance in 2022, but I don't think by any stretch of the imagination will we see a balanced market in 2022. I think what we're going to see is the market starting to go that direction. And again, as I mentioned, I think we're starting to see that here a little bit at the end of 2021. Housing prices will continue to appreciate, but they're just not going to appreciate as strongly as they have been the last couple of years. Again, in some years, we're seeing double-digit increases in pricing. So if we don't see that, it doesn't mean the market's crashing. It just means the market's correcting itself. And I think that's a big difference and something that definitely, we hope people understand. So home buyers will have more to choose from, but inventory shortages will still continue to drive prices up. So again, I mentioned we're already starting to see a little bit more homes come onto the market, and that's a good thing. That's really where we need to be at. That's true of both existing home sales, and it is true of new construction as well. New construction has been lagging tremendously over the last 10 years. That's a big part of why we've been in this inventory crunch, but I think they're starting to do a little bit better from their point of view as well. And lastly, again, the apartment demand will remain robust. I think what you're seeing in the home buying market will probably continue to happen in the rental market as well. So that concludes my presentation. Unless anyone has any questions, I'm happy to answer them. Yep. Sure.
I see the same thing happening in Cedar Lake that you explained up there. In 2006, we had our highest new construction permits of 219. In 2011, it dipped to only 30.
Right.
In 2020, we broke a record of 280 new construction permits, and right now through October, we're at 313 permits. And we have approximately 5 multi-million-dollar houses on the south end of Cedar Lake, 781-acre lake. And Schilling, you had listed up there, is one of the major developers in my town.
Yeah, and I'm glad to hear that because the new construction market, housing starts, absolutely is what's going to help us balance this marketplace. And it has been the sector that's lagged behind the most, unfortunately, for a variety of issues, and I'll let my home builder friends speak to what their constraints are, but I know it had to do with labor and supply, and then recently cost of materials and things of that nature. But new home sales has always been a relief for existing home sales, and while existing home sales has rebounded nicely, new home sales has not, although in recent years, specifically even in the last year, to your point, it's gotten a lot better from what I'm understanding, so great news.
It's not a question, Don, but it's a comment from workforce. This issue of housing inventory in an affordable range is a major workforce issue. Okay, that is not going to change. And that's pre-pandemic. Right?
Yep.
This isn't new. And I may be stating the obvious, but I don't hear it talked about as a workforce barrier. And as a community, we've got to tackle that.
Yeah, I echo those sentiments, and it absolutely is a concern from our organization's point of view. And so anything we can do to help with that, we're always happy to. And I know, Lisa, you and I have had some conversations like that in the past. So again, I echo those sentiments. So
Pete, you're going to be around for a while?
yeah, yep.
So I know there's probably a couple other questions back out there. I'd say one of my takeaways was that I think I'm going to sell my house and move in with my kids. So thank you, Pete. All right, our next Why-Notter is Ty Werner. He's the Executive Director of the Northwestern Indiana Regional Planning Commission, also known as NRPC. It's the Regional Council of Local Governments serving Lake, Porter, and LaPorte counties, the official MPO, the Metropolitan Planning Organization of Northwest Indiana. I think they are the place where all the federal money comes through to come here. And he'll clarify that for us. In his role, he's responsible for coordinating regional planning and development in Northwest Indiana. And this morning, Ty will talk about the economic recovery and the value of place. He's got a Bachelor of Arts in Philosophy from Wheaton College, so I mean, we'll get a little bit of a flavor about what we should be thinking about for the future. And he's a master's in urban planning from the University of Illinois at Chicago. Please give a warm welcome for Ty Werner.
Great. Thanks, Tom. Appreciate it. All right, thanks. So don't leave, but everybody stand up and stretch. Just get an opportunity to stand up and kind of shake things out. I know you've been sitting a long time, and that's a ton of information, so just get an opportunity to get a little bit mobile. And while you're doing that, I'm going to start with a story that literally just happened yesterday while I was getting my car worked on. So the guy that was working on my car and was telling me what I needed to do, which as always happens was much more than I thought I was getting when I took it in. We just started talking and realizing that he also came from the western suburbs of Chicago, where I was for a long time. So we just got to be talking about that a little bit. And he's been here, I think, it's been a year or two since he moved out here. And his comment was, I couldn't wait to get out of Illinois. So that was just yesterday. And I know a lot of you have heard similar stories about that. And people told you the same thing about why they moved here, just building off of Pete's presentation. But I want to try to submit that although that's important to seize that opportunity of that movement, we are so tied into the Chicago economy that it is not a zero-sum kind of game. So our goal is not to steal people from Illinois, it's to try to create a better place in Northwest Indiana. And if people want to make that decision, that is awesome. But we have to grow the entire economy of this region for all of us to succeed. But I think the big thing right now coming out of COVID is how do we make sure that we recover well, and how do we make sure that we have the places that people actually want to go to? So when Illinois does get their act together, we're not behind now with that. We have an opportunity now to try to build up our places where people want to come to Northwest Indiana. And those people in Illinois, even though they're paying a lot higher taxes, I think a lot of them will tell you, and I'm not trying to hurt anybody's feelings or be frank, but I think a lot of people will tell you that they're paying higher taxes, but they have a lot of amenities that they really enjoy that frankly we don't have here yet, at least not in spades. We have a ton of assets, and that's what I'm going to talk about. But it's not a zero-sum game. We just have to work now on trying to build our place better so that we can attract folks from other places. So a quick word about NRPC. I'm not going to go on too much about this because a lot of you are familiar with us already. Northwestern Indiana Regional Planning Commission is not a state agency, but state statute forms us. And we are a council of local governments for Northwestern Indiana. So for our region, it's Lake Porter and LaPorte counties, and all 41 municipalities within those three counties, basically interact with NRPC on a regular basis to talk about things that are larger than any one of them. And each one of you in this room has a representative that you've elected from your town council or city council or whatever that is appointed to come to NERC. So you have a direct channel by your representation for what happens at the Northwestern Indiana Regional Planning Commission. For example, from Cedar Lake, Bob Carnahan, who just asked a question recently, is our commissioner represented on the NERC Commission. So you all have somebody you can talk to with direct input into this. These are our four main topic areas that we organize our own structure by, and then, and I won't spend time going through these, but these are the committees that some of you are involved in already that fall under those pots. But our state statute lays out specifically 3 topic areas that we are supposed to be engaged in developing plans and programs for: transportation, environment, and economic development. I'm really going to mostly focus on economic development today. Most people know us for transportation. We have a transportation improvement program, a 4-year plan of projects that is about $1.5 billion of projects over the next 4 years for Northwest Indiana. And again, that's what we usually get in the paper about, that kind of thing. But I'm really going to focus on this third point because so much has happened in this topic area during COVID and now coming out of COVID. And our main shtick, if you want to call it that, is even with our function as the Metropolitan Planning Organization for Transportation Funds, or a new designation I'm going to talk about in a minute, we work with federal agencies on a regular basis. So in transportation, we help connect communities with the federal grants that are available to receive those funds to do those transportation projects. So you can see just the different federal agencies that we work with on a regular basis to accomplish each one of these topical areas. But I'm going to start off by talking about shifts with the 2020 census that hopefully you filled out your census forms, because those federal agencies that I just talked about, so much of what they do and so much of the money that comes to Northwest Indiana is dependent on whether or not you fill out your census questionnaire. So I already mentioned Bob Carnahan, so since I already did once, I'm going to call him out yet again. He's been a big champion to try to increase participation rates in the census. It's too late because the numbers are out, so I'm not going to shame anybody if you didn't return your census form, but I just want to emphasize again that this translates into direct dollars for Northwest Indiana if you don't. So there's numbers. I'm not going to go through numbers, just to talk about the overall change. The NERC region, and when I say NERC region, again, that's Lake Porter and LaPorte, did grow, but honestly not by a ton. So this is the 2020 census results, 1.6% growth, 12,000 population increase. So that's good that we didn't lose population, but we didn't have a ton of population in that period. But keep in mind, the census questionnaire was April 1st of 2020. So that's when everybody was already shut down. So you had COVID going on. And some of the stories and some of the graphs that Pete showed, if these trends, I think a lot changed in COVID where people were looking at us and making other decisions. So these numbers may not be accurate or reflect the full picture, but this is the 10-year census interval of increase. And this is how we compare to other places that are comparable or near us. So there's Northwest Indiana at the bottom at 1.6%. I know the perception is that people are moving out of Chicago, but keep in mind, population changes are all based on births, deaths, out-migration, and in-migration. So there's all those 4 factors going on, and I don't know, and even the census results we're still getting data out of that, so I can't speak to exactly what was going on here, but the Chicago area actually did gain 0.1% more than the Northwest Indiana region. So it's not totally people flocking across the lines, at least according to the last 10 years. Southwest Michigan, this was a big surprise to me, actually lost a little bit. But South Bend, 3% increase, Indianapolis area, 13% increase. And I'm going to come back to this point, but I would submit that South Bend and Indianapolis are 2 places that have made, particularly Indianapolis, but have made significant investments in their quality of life and their downtown areas. So, and I think that's not unimportant. This is a slow animation. Each one of those dots represents 200 people. So this is 2000 and then shifting. You see people come kind of east and south in 2010. And then finally, in 2020, people concentrating or spreading out depending on where you are in the particular parts of the region. So there's some overall shifts. This is what it looks like. This looks funky because this is census tracts. But this is what it was in 2000. The areas that had gained the most population are the highest, or the deepest red there. And then looking into 2010, again, there's a little bit movement further east, a little bit further south, and I think this probably corresponds to your own experience. That's what the census showed in 2010, and then looking on in 2020, a little bit more fragmented growth. So that's what the 2020 interval was between 2010 and 2020. So that's the population changes, and the municipal population changes are there. You can see the darker green is who gained the most population, and the brightest red is who lost a lot. And again, we have our areas in the Northwest area that are particularly facing some significant challenges with this continued gap. Here is the, and I know you probably can't see the detail of this from where you are, but this is each of the 41 municipalities in Lakeport and LaPorte County. And the highlight, I think, here, of course, the biggest areas are still Gary and Hammond for largest population. Both lost population, which may not be surprising to you, just again, based on your own experience and whatnot, and just accentuates the challenges and why we need to focus on those areas. But Gary lost a lot more than Hammond. So Hammond had already tipped Gary in the most populous municipality in 2010. That just accentuated in 2020 because of population loss. And then there's some areas though here like Winfield, which is that has a much lower population, but really almost doubled in population over that time period. So you see that. And then here's density, population density, and density doesn't always translate to vibrancy, but it often does. And that's a word that we're talking a lot about more and need to talk about more. And so if you think about it in those terms, you can see, I think one of the ones that stands out is Crown Point, right over here, and their increase in population density. And I swear I am not touching the side of this cursor thing. So we were trying to figure out why it was putting the cursor all over the screen. I'm sorry if that's distracting, but we're doing our best here. We're not quite sure how to get that off. So here's a minority by census tract, and I don't think there's any huge surprises here, but this particularly plays into our federal planning efforts. We have to show that we are engaging in a process of determining environmental justice, and what that sounds like maybe a little bit different than what it actually is. We have to show that the investments that we're making, I mentioned that $1.5 billion in transportation projects over the next 4 years, is not particularly putting extra burdens on population that have already been burdened enough. All right, so we need to try to look at this whole picture of where we are putting investments to try to build places up, not continue to segment them. And I think one of the things that's exciting out of the discussions of recent infrastructure bill talks is that there's a focus on trying to reconnect communities that have been divided by interstate building in the past. And how do you reconnect communities that, frankly, in a time period where we were a little concrete happy with building interstates in this country, how to reconnect communities and make them vibrant again, where we literally separated some of those communities when we built them. So that's why that is critically important. Here's the self-response rate, particularly of note, again, to Bob Carnahan, who's been a big champion of this. Indiana did do a little better than the national response rate at 70%. Here's how it shakes around our counties. Lake County didn't, pretty close, but it's just a little bit below the Indiana response rate. Porter County did much better than Indiana on the response rate, and LaPorte County did a little bit less on the response rate. So next time that census goes around, encourage your friends to fill it out and send it back. So we had already started, prior to the pandemic, engaging in this e-commerce study. This is all the stuff that you get delivered to your doors and all the rest. I'd like to say that we were really, really smart and foresaw COVID happening and that this was going to be like the top thing, but it just happened. We had started this study, COVID hit, and then this became all the more relevant, all the more, as you know, because everybody was getting stuff shipped to their homes all the time. So I told you about that transportation is a big part of what we do. This is by mode. So at that top line up there is VMT stands for vehicle miles traveled. So that top line, and again, this is pre-COVID, and anything I'm going to show, a lot of this stuff is pre-COVID data, so it's helpful to keep in mind what changes do you think happened during this weird period that we're hopefully starting to come out of. So here's all the VMT from between 2014 and 18. I forget exactly what happened and why this slight dip in 2016. I think gas prices were really low. I think that was what contributed to that. I forget the exact reasoning there. But the important thing here for e-commerce is here's the truck vehicle miles traveled, which is on a steady increase and is continuing to increase. And I think we've all witnessed that just going down the Borman or wherever else. You deal with this as you drive on every day. You're seeing the exact impacts of the choices that you're making to have stuff delivered to your home is making this problem worse. I'm not blaming you, don't hear that. I'm just saying this is all related, that as you order stuff, it's got to come from somewhere, and then it's got to get shipped to you, and then it means it's got to come on trucks to get to distribution centers to get to your home. So this is all one big picture. And I said this, I think the last time we presented was 2019, and I said this back then because we were already looking at this data. But we do a household travel survey, so this is last time we did it was 2018. And this is surveys that some of you in this room may have filled out about where you were going and all that. So we take that data back, and here's the big ticket item that jumped out at us from this data is in 2018, 21% of your vehicle trips as you drive around the region were for shopping. In 2018, that had already reduced by 12%, down to 9%. So you're going to stores less, which means you're ordering, well, presuming you're buying the same amount of stuff, you're ordering stuff to your home, which means that that's translating a little differently to now there's the Amazon Prime truck or the FedEx truck or whatever coming to your home instead of you going to the store. So we were already seeing that data before COVID. And then translates into vacancies. And again, this is pre-COVID data, but across the region where there's percents of vacant businesses, where the darker blue is where there's the most amount of vacancies, where we're talking brick and mortar stores and that sort of thing, and the effect that some of this is having on that. Only expected to increase. Again, this only goes to 2020, but you see the rapid rise in e-commerce. And then in employment, see truck transportation down there, less than 3.4% drop. And that's why you see every truck that passes you, I think, has the hiring sticker on it. But look at warehousing and storage with a 50% increase in employment. So dramatic. And Northwest Indiana, just as a tidbit here, exceeds Indianapolis in terms of its share of industry there. So this is portraying a 100-mile radius around major distribution centers, fulfillment centers, coupled with those dots are the areas with the highest percentage of millennials. And I don't want to oversell millennials because I think millennials are getting sick of being talked about as a group all the time. But I'm going to come back to this slide later on and just kind of pay attention to where those places are where most millennials are located and think about your experience in visiting these cities and what your image is of these cities as you reflect on what's going on in those cities and why you think they're attractive to millennials and why that dot actually doesn't appear in our neck of the woods. So I'm going to come back to that later. So I'm going to run through these maps. Don't worry about getting caught up in these details. But just in that e-commerce study, here's the whole transportation network, including expressways. They're mapped against warehouses, stores for storage, warehousing, et cetera, and where those are in Northwest Indiana. Mapped against environmental constraints, like where it's very difficult to build in. Mapped against where the population is mostly locating, population density in Northwest Indiana, mapped against employment density, and then came up with this, which is in our e-commerce study, which is the potential locations for e-commerce that make the most sense with all those factors involved. So as an economic development tool to try to capitalize on this trend, how can Northwest Indiana most jump on this and try to take advantage of it? And this is a little technical, but we have in our transportation model where we plug in where everybody's going, we have transportation analysis zones, which is what TAS stands for. It's places that generate trips, places that attract trips, and then you figure out the route of where they're going to go, and that's what the model cranks out. So with all that into account and all that data that I just showed on the previous slide, those black outlined areas are the ones that actually make the most sense for fulfillment and distribution within this region. So this is all in our study. It's all on our website, and would encourage you to go look at it. It's got several key recommendations in here, but the one that I want to highlight, which is particularly relevant to our cities, is the importance of the curb and delivery. And I think in 2019, I talked a little bit about autonomous vehicles, which I'm not talking about today. But I think I maybe made the point then, too, that aspect of the curb and how you let people off and let your vehicle go away and you get off the curb, plus e-commerce and how you let people deliver packages to your goods and get out of the way so you don't block streets and everything, that's becoming more and more important all the time, is this whole delivery aspect. So you don't have something like this area on the right, which is blocking an entire street just to sort out all the goods that people are ordering through e-commerce. So there's got some solid recommendations. This is in our study. I'm not going to talk about this except to highlight, kudos to Ivy Tech and their supply chain management program, which is already on the ball and trying to take advantage of this trend. All right, so I mentioned a new designation that NERC has received, and again, this couldn't have been more fortuitous. We received this designation in 2019. It was over a decade in the making, and finally got it in 2019, just before COVID, which timing could not have been better. Not that we're thankful to COVID, it's just I'm really glad that we got the designation before COVID hit, because it meant that we got access to all these normal programs, which the EDA has, and I'm not going to spend time on these either, but these are all things that are now, because of that designation, more eligible for Northwest Indiana than they were before we had that designation. So now we can help get federal funds for economic development that we did not have prior access to, and that's all the programs that are available for that. But then Congress came in and passed the CARES Act, Coronavirus Aid, Relief, and Economic Security Act, which made even more funds available to Northwest Indiana because of that economic development district that we had just achieved. So direct correlation between getting that CARES Act funds to Northwest Indiana. And I'm going to talk about two of those programs, two of those projects that came directly out of that will, one is available now, one is going to affect you shortly. Recover NWI is what we're calling our Regional Revolving Loan Fund for Lake, Porter, and LaPorte counties. And I've tried to avoid putting text on these slides. This is the one set of slides that I'm going to put text on because we need your help in helping to spread news of this program. We have $530,000 that we have to spend on this program and get out there by next summer. All right, so $530,000 to help small business that have been injured by the pandemic and by COVID-19 that can demonstrate a loss and can take advantage of these funds and these loans. So how do you get the funds? That is a great question. I'm glad you asked that question. So here's your eligibility. You have to exist prior to January 1st, 2020, and you have to be able to demonstrate that you've been injured by it. Again, this is on our website. I'll give you the website in just a minute, so don't panic so much like you have to take pictures of this. Minimum load, 10,000, maximum loan, 100,000, low interest rate. There is an application fee, but it's, again, this money needs to get spent, so it's out there to take advantage of. And I just want to thank our partners, Erica Dombey, a regional development company who's underwriting these loans, and then Lori Felt and the folks at the Indiana Small Business Development Center who can help those businesses with their business plans and all of that. This is the contact information. So if you do want to take a picture, this is the one to take a picture of. So this is NIRPC.org/recover-NWI, NIRPC, NIRPC.org/recover-NWI. And Matthew, I was warning him I was going to call him out. Matthew Paskash is our economic development specialist, and I think he's sitting right over there. Yeah, right. Already the pens are going to him. So please contact him, not only if your own business needs this assistant, but if you know folks that have been injured that need this assistant, please spread the word about this. I think if he was able to bring up, I think Matthew's got some flyers on the program as well with this information. So go to that website. We went to great lengths to make the whole application process electronic and hopefully easy. Although those of you who are, I'm going to go ahead and say this, those of you who have been in business a while and are experienced in the business world, what we're finding already in these loans is because of the loans that these are typically going to, these are people that are not used to doing things like profit and loss statements and this kind of stuff. So we're having to do a lot of hand-holding, and this is not our primary area of expertise. This would be a lot more helpful and more successful if you know these folks and connect us with those folks, and then even if you can, you know, if it's a friend of yours that you want to help with this, help them with that process would be really great. So that's the one program that one of the programs that came directly out of the CARES Act. The next one I'm going to talk about really briefly, because this is just launching like in the matter of weeks, is the Northwest Indiana Economic Resiliency Plan. And we also received funding for this. And this is how do you help Northwest Indiana strategize and position itself to prevent loss in future pandemics, heaven forbid, or other disruptions that could be of a natural disaster sort or whatever. How do you make Northwest Indiana more resilient so that it recovers faster from those kind of disruptions? And that's what this is all about. So we had already been working with the Purdue Center for Regional Development to develop this dashboard, which they had been working on. And again, not focusing here, this is just to scare you, to show you that these people in the academic world are really smart and trying to look at all these variables that feed into the dashboard that they're trying to create. And this is examples of the things that are on their dashboard that they're working with. I'm not lingering here just to give you an idea. So they're looking at all these inputs. So we've already got that going on with Purdue. And then we received money to develop this plan. We've just signed the contract. Now it's about to get going with TIP Strategies, which is the firm that was hired by the Northwest Indiana Forum. Heather Ennis is right up here, which spearheaded the Ignite the Region effort. So these folks, based out of Austin, Texas, are already geared up and familiar with our region that they can hit the ground running for this plan effort. built on everything that a lot of folks in this room participated in with Ignite the Region. So there's a lot of continuity to take that Ignite the Region plan and use everything that they already learned in that and then create this resiliency plan, which will have a timeline of getting adopted by next summer. There's the overall timeline for the project. So that's just about to launch. And I know they want to talk and re-talk to a lot of folks that they talked with for Ignite the Region. So you may be, if you were involved in that, you may hear from them again, or even in certain segments that you're involved in, you may hear from these folks as they try to talk to you about your impressions. But wait, there's more. So if the CARES Act weren't enough, then Congress came back again and passed the American Rescue Plan Act of 2021. And this provided an opportunity, as Don mentioned earlier on when we got going, for a $1 billion grant program, national grant program, for the Build Back Better Regional Challenge. This is in 2 phases. If we're successful, we submitted our application a couple weeks ago, and I'm going to talk more about the coalition in a minute. But if we're successful in that phase 1 of a $500,000 award, that enables us to use that money and go on to apply for the phase 2 award, which is a potential $100 million from the Economic Development Administration for Northwest Indiana. And the focus of our application was the Midwest Quantum Corridor, or part of the Greater South Shore Initiative that has already been talked about some. This is to take advantage of the fiber-rich area that's already within the Indiana Toll Road and within the NICD area. Mike Nolan's going to come up here very soon within his own corridor, so we have redundancy. We are sitting on, I don't know if you're aware of this, but this is becoming more a focal point all the time of what we're sitting on here in Northwest Indiana, that the crossroads of North America is not just about transportation, it's about the fiber that we have not fully tapped. And quantum computing is a huge topic. And I'm not even going to try to summarize what it is, but it's huge. So this takes advantage of the Hammond Data Center that's just opened recently, right up against the Chicago border, which is all, I'm trying to take advantage of this cursor deal to use it as a pointer. And that's working. And then which also takes advantage of 350 East Cermak, which is like a big data nucleus of the internet, all the way to the South Bend Research Corridor, and then potentially on to Ohio and elsewhere to take advantage of that fiber within this corridor. These are our coalition partners, which we're really grateful signed on to this grant as part of the actual coalition. Great group of folks that are committed to this region and have done a lot of thinking about this already. They did have certain requirements with the EDA that they could not be a for-profit business or an individual, so all these folks are nonprofits or governmental organizations. But then there's a larger group of support letters that we received for this that are all in on this proposal, and that's represented on this slide as well. And while I don't want to disregard anybody on this list because they're all phenomenal, I just want to point out in terms of the folks that actually understand the details of this quantum corridor and how important this is to the nation, not just to Northwest Indiana. Digital Crossroad are the folks behind the Hammond Data Center. Vivacity puts sort of the fiber plumbing in place. But we've also received support letters from the Chicago Quantum Exchange, which is based in University of Chicago, Pritzker School of Molecular Engineering, Argonne National Laboratory. They all see this as absolutely critical and have a vested interest in completing this corridor and taking advantage of the fiber that runs right underneath us here. And including places, if I were to pop back to that earlier slide on minority and changes in the region, runs right under Gary, Hammond, East Chicago. And so the benefits for those communities to be able to tap that fiber is almost incalculable. So I don't know that I can undersell how important this, or oversell how important this is. And that's why this overall corridor was the focus of the One Region luncheon that just happened recently. Marie Foster Bruins is in here somewhere along the line. Thank you. Marie is back there. And this is a big focus of this with Senator Todd Young and Congressman Frank Mervan in attendance for this. And then also it's included within the Ready Grant application that the Northwest Indiana Forum and Heather Ennis up here put together on behalf of the region, which includes phenomenal projects, which we hope receives funding for the state. So this is all of a piece. So really quickly, I'm going to end on kind of this note, because I think I've said this every time I've spoken here, and I just made up this quote, but I just think it's really important to keep in mind, because so many folks identify NERPC with transportation, and rightly so, because that's what we do. We help provide funding for transportation. But it doesn't matter how many ways you have to get there if you have no place that anyone wants to go to. And so transportation is, and always has been, is about connecting cities and places to just get from one place to another. If you don't have those destinations that are valuable and important for people to want to actually show up in, then it's almost no point in building the network to try to get to those places. You're just passing people through our region just to get someplace else. And we want people to actually be in this region, not just get on to Michigan or to wherever else they're headed to. So I said I'd bring back this slide. I'm bringing it back again. Again, all these places here that have the highest percentage of millennials, what are the kind of places that they're attracted to, where they want to be, where they want to locate to? A truism that's worth repeating, people are now deciding where they want to live before they're figuring out where they want to work. So they're locating the places that have the amenities and the assets that they want and then figuring out their job after the fact. It's not like it was earlier where you just go wherever you can get a job. They're locating where they want to be and then figuring it out after the fact. And if you have millennials, I think you know this is true. So I'm going to end on this slide. I know Phil Tallion's in the back, so I hope he appreciates this. This is the city of Hammond, which is just such a phenomenal project, but I think illustrates what I hope we are all thinking about in the region that I think is worth highlighting, because I'm not sure it got highlighted enough, frankly. This is the city of Hammond's downtown plan that they created. A picture is worth 1,000 words, and these visuals represent a lot. So when we talk about transit-oriented development and I'm trying to set Mike up here for his talk. So when we talk about transit-oriented development and what that actually means when you hear that term, think pictures like this, because this is what we're talking about, is walkability around station locations where transit is integrated with your needs of daily living, so you don't have to jump in your car and drive a mile to get a gallon of milk. So you can function without necessarily getting your vehicle. And this demonstrates two potential new station in downtown Hammond and takes advantage of that on the new Westlake corridor. This is Homan Avenue and how they make that a much more pedestrian-friendly space, much more walkable, much more attractive outdoor living room, arts area, almost like an arts incubator. And then this is the last slide, so Mike can come on up, is residences located near the potential train. I'm trying to use this pointer thing. Near the potential train station with the new Westlake corridor right in downtown Hammond, and take advantage of being able to walk to that area. So that is what we need to think about when we think about everything that we're coming out of COVID. Just to accentuate it again, how do we, to use that phrase, build back better, whether or not we receive that grant, and I hope we do. How do we build back better in a way that as we recover out of COVID, we actually come out of this even more attractive than we were before we came? We talk about our assets, and those are wonderful. Nobody else has got the lakefront that we do. There's a lot of things that are even hidden, like that fiber corridor. But until we activate those places and people know about them, we may not recover in quite the way that we are hoping that we do. So we have a lot of potential here. It's up to you whether you want to take questions or not.
One or two.
Great.
Okay, how does Mercy help the town of Gary get a plan like him?
That is such a great question. Did I set you up with this question? Because that is great. So the mayor of Gary actually talked to us about that very question not too long ago, and we're trying to work out how we can help fund that and find funding sources for Gary to help get to that point, because that's the kind of thing that they've already expressed that they want to do, which I think is phenomenal.
Okay, I'm sorry, I
Yeah.
have more questions, so maybe I have to.
I'm deferring to my moderators. And I'm over here, and he's over
You're
there.
good,
so-
yeah.
So first of all, I'm a recipient of the recovery.
Phenomenal, thank you. Great.
As a small business owner, this may go back to the workforce as well as you guys. With all of the changes impacting the minimum wage requirements, what can between workforce, NERC, and the other government agencies do to help us better transition ourselves to better be able to get to the minimum, the increased minimum wage, and transition our businesses so we don't put ourselves out of business, employing folks at these minimum wage levels with all of the other encumbrances, supply chains, and everything else that's involved.
Thank you for that. I don't know that I can answer that question, but I want to augment your question, because I think that is a prime reason of why these folks are gathered here today, is to try to answer that very question and to connect those dots between workforce, between what's development opportunities that we have, between the grant programs that we're trying to achieve, and how those things all fit together. I don't have a direct answer, but I think that question is absolutely critical to what we talk about the rest of the day. Because again, it's folks on the ground that are trying to make a living, that are trying to create a business, that are trying to contribute to this economy, that if we can't support them and help them actually succeed, then we're missing out on an opportunity here to recover well. So.
So I noticed on the grants, which are amazing, that there's no construction or renovation grants, but that's precisely what the city of Gary needs. We need money to take down the buildings, we need money to do housing,
Right.
so help me.
So thank you. So I was, just to be clear, that, that was one grant opportunity for the Recover NWI, but there are other grant opportunities on that first slide that I showed that the EDA, and that's just one federal agency, has that can get into construction and can get into some other aspects. And I already referred to Matthew Paskash, who's sitting right behind you, but Denery Kane is sitting even further back. Denery, I don't know if you can raise your hand. Denery is our Economic Development District Coordinator. Some of you may have worked with her when she was with the City of Hobart. So she's been in the region a long time and knows us really well. She is our Economic Development District Coordinator and is serving as that conduit point to the Economic Development Administration to help connect those kind of opportunities to those grants. Is that good?
I was going to be impressed if you answered that question, because Northwest Indiana's been working on that for a long time.
Yeah.
And I'm going to argue that it comes down to leadership, and specifically within your own community, figure out how to use these tools and other tools that are available in the state to actually build your own economy. And it takes a long-range plan, and particularly for some of the stuff you're talking about, it's going to be the city or... Is it on high? I mean, a little more thunder. Thor's going to be up in a minute, but I mean, it takes leadership and getting organized within your own community. And most of them, there's a number of economic development corporations here today. I know the Lake County Economic Alliance, Don Kolobowski's here with them. I saw Clarence Hulse from the EDC of Michigan City. I don't know if there's some folks here from LaPorte. But those organizations, when you get a strong economic development corporation within your own city to start trying to tackle that stuff, that's how you make it happen. And it's a 10, 20-year approach to it, and taking advantage of the tools that are already out there and educating yourself and getting good people on those boards that are really working night and day to try to answer those things, because they are not easy answers, and nobody else can do it for you. It's coming to events like this, networking with people, and spending time with those that actually have figured out some of it, because nobody's got the silver bullet on that question. So I applaud you for coming today and educating yourself, and I'm sure you'll have a chance afterwards here to talk to a couple of people. And certainly, I'd be not that I know a whole lot, but I'd be glad to talk to you too if that would be of any help. Yep, and well, we all do. So we learn from each other. So one of the things on the why not side, right? Why not have a quantum computing center at Purdue Northwest in Westville at the end of that fiber line that Ty was talking about here? I mean, there's a lot of opportunity to dream about these big things and then pursue them. So and on the pursuit side, you know, Ty talked about the EDA grants and availability for those. That stuff has been around 20, 30 years. And prior to Don Kolobowski at the Forum, working with NERPC over years and years to go through the application process, we still wouldn't have had that money coming from the feds, because without that designation, the money is not coming to Northwest Indiana. And a lot of people around here for many years talked about it, but nobody really dug in and did the hard work that was required to go through the process to actually get that designation. So congratulations to NERPC and the Forum both for their outstanding effort to make that happen, because it's literally millions and millions of dollars that were opened up to come to Northwest Indiana. So it's an honor for me to introduce our next speaker here, by the way. So I've got a long story about Mike and Carrie Nolan, but Carrie, stand up, his lovely bride, please, come on, because there's no man smarter than the woman he stands next to, so thank you. So Mike Nolan, he's the president and general manager of the South Shore Line and Northern Indiana Commuter Transportation District, NICTD. He's responsible for the day-to-day operation of the commuter rail service of the South Shore Rail Line, the nation's last interurban railroad, which operates 90 miles of commuter intercity passenger rail service between South Bend and between the South Bend International Airport and Millennium Station in Chicago. It's also responsible for overseeing the Westlake Corridor and the double track projects, were cornerstone of NICTD's 20-year strategic plan, which was adopted in 2014. And good for us is because that's the year they hired Mike Nolan to come in and run the place. So both projects are the largest transportation infrastructure investments in the history of the state of Indiana. The projects are expected to bring additional dollars in the future and further enhance commuter rail service in the region. He had over 28 years at Metro, so when he came here, he brought years and years of experience in their rail line when they got this tremendous expansion to the west, and now he's bringing expansion from Chicago to the east through Northwest Indiana. He's got a bachelor's from Notre Dame and a Juris Doctor from the John Marshall School of Law. So I'm so proud to have this young man live in Northwest Indiana, but he reminds me, and many of the other speakers remind me of the man in the arena. And I'm going to read a little something here from Teddy Roosevelt. It's not the critic who counts, not the man who points out how the strong man stumbles, or where the doer of deeds could have done them better. The credit belongs to the man in the arena, who is actually in the arena, whose face is marred by dust and sweat and blood, who strives valiantly, who errs, who comes up short again and again, because there is no effort without error and shortcoming. But who does actually strive to do the deeds? Who knows great enthusiasm, the great devotions, who spends himself in a worthy cause, who at best knows, in the end, the triumph of high achievement, and who at the worst, if he fails, at least fails while daring greatly. So that his place shall never be with those cold and timid souls who neither knew victory nor defeat. And I think that characterizes Mike Nolan to the T, because, you know, my mom took the South Shore for a better job in Chicago when I was a little kid. And we've been dreaming about expanding the South Shore. That's like 60 years ago, kind of thing, just to give you some time frame. Like, you know, decades and decades, until he came here with his leadership and working with Bill Hanna, we weren't going to get this thing done. And him particularly championing the double track, which politically allowed all of Northwest Indiana to get behind this, because what was happening was we were getting this split between the existing South Shore cities, which felt that their South Shore service was weak, and we wanted to put this big expansion to the south without improving their service. And he figured out how to do it together. So, you know, please give Mike Nolan a big Northwest Indiana welcome for all he's done and for all that he's going to do for us. Thank you.
Thank you, Don. Is this working?
Yeah, you're good.
Good. Everybody hear me? Well, you know what? I probably don't need a microphone. So can everybody hear me in the back? All right, we're good. I was born to song, so that shouldn't be a problem. And thank you, Don, for.
You might want to use that because that's not sounding too good.
How about that? We good? Okay. Thank you for having me today. We're excited to be at this point in time in the rail projects. Don is right. We've been talking about if we could build these projects for years. There's minutes of meetings going back to 1927. The South Shore Line wanted to double track the railroad at that point in time. There's visions of the Westlake Corridor that go back into the 80s. Janet Moran and others who formed the Hammond Interstate Rail Commission. Pete Visklosky championed the Westlake Corridor project and then the double track project when he was our congressman. We have congressional delegation support for years. Local support came together ultimately, and we got it done, Don, in the General Assembly. We're bringing $1.5 billion worth of infrastructure projects to Northwest Indiana, and we're just about ready to put shovels in the ground. So it's a congratulations to all you who made it happen, who supported us. We can do things in Northwest Indiana, and we proved it when we went down in a unified front to the General Assembly. And I know I was supposed to be done at 10:40. Bill, the train's going to be late today when I hand it off to you. But we took the handoff late. And so we've been talking about if for so long. It's so much fun to change the presentation to not if, but when. And so I've titled the speech now, Pardon Our Dust, because that's what we're going to be creating here over the next 3 or 4 years as we begin to construct both of these projects. So again, the title I toyed with was Coming Soon. What a really fun marketing tool to talk about an amenity that's going to be added here to Northwest Indiana. Not only are we going to significantly improve the service along the main line, but we're building the first new rail spur here in Northwest Indiana in over 100 years. So coming soon to a location near you is substantially improved rail service. Here's a map of the South Shoreline as you all know it. We have 13 stations, 12 of them in the state of Indiana. We also provide service for the Northeast Illinois region through our Hegwish service. This is one of my favorite slides. It shows the commuter rail network that exists in Illinois. You can see how much rail service they have and why they're not only mega center in Chicago has grown, but it's been supported through rail service that goes on a hub and spoke system all throughout Chicago. We've had one rail line this entire past 100 years. With the development of the Westlake Corridor, we are going to now serve an underserved area of Westlake in the Westlake Corridor in the state of Indiana to grow and provide more transportation opportunities. Westlake is a $944 million project. I will note that we also received some extra funding that Ty mentioned. We got an extra $43 million from the federal government came our way for the Westlake Corridor. And we are in the process right now. We have awarded a contract. It's a design-build contract to an FH Passion Ragnar Benson joint venture. Matt, are you still here? Raise your hand if you're still here. There's Matt Moss. Stand up, Matt. For those of you who don't know him, Matt's the project manager for FH Passion, who's building the Westlake Corridor. And so we have a project office that's in Hammond, where the teams, our team and Matt's team, meet every day, and they'll be turning dirt here very, very shortly. The double track project right now is a $495 million project. Oh, that's probably going to get adjusted. And it also received an extra $24.5 million out of the American Rescue Plan. I will note that of those funding dollars, a huge percentage of those dollars came from the state of Indiana, from the counties, the 4 counties here in Indiana, from municipalities here in Lake County, from our Regional Development Authority. This has been a mixed funding association from local, county, state, and federal levels. It is truly a partnership. And here is a reflection of that partnership. The Regional Development Authority is our fiscal officer for this from the state of Indiana, helping us run these projects. And our funding agency is the Indiana Financing Authority. The beauty of having the IFA in this is that we can go to the market for whatever debt service we need, and we get the strength of the state's AAA credit rating that it attracts a lower interest rate to fund these projects. And then finally, of course, the Federal Transit Administration. The federal government's putting in approximately 40% of the funding for these projects, and they're truly a partner as we move these projects forward. Why do we do these projects? Well, the issue that's highlighted is probably going to be the topic of Bill Sheldrake's presentation, so I'm not going to mention ROI, but certainly there's jobs that are going to be created. Certainly we have probably a couple thousand construction jobs that are going to be created as we move forward for both the Westlake and Double Track project. Those are temporary jobs, but there's permanent jobs that will be created. Our South Shoreline rider, when we study their profile, on average, our riders earn around $90,000 per year on a household, which is about twice as much as the average household income in the 4-county area. The more people we can get to go into Chicago, earn the higher paid wages, have the opportunity to go there with better service, and come back and spend those dollars in the region, the better off we all are. And the jobs in Chicago pay, on average, about 40% more than they do here in the 4-county region. We believe that when we put these infrastructure improvements in place, we'll more than double our ridership over a 20-year period. And I'll let Bill talk about TOD and transit development districts, but that's certainly a main area of emphasis, is to grow our cities like we haven't grown them before. Here's just a slide that shows that, and we've done modeling as to what we expect the ridership increases to be when we put these infrastructure improvements in place. I can tell you that maybe it's hard to see the slide, but we were running, now these are pre-COVID numbers, but we were running around 12,000 trips a day. We expect when we add Westlake and Double Track that we'll go to about 27,000 riders a day. It's a significant increase in ridership opportunity. Again, coming soon, I'll talk about Double Track here. We are in the process of looking to award our main construction contract for the Double Track project. We anticipate awarding that contract and starting major construction in the construction season of 2022. We'll have a full season in 22 and a full season in 2023, with revenue service opening up in early 2024. There's just a couple renderings. The bottom right, you'll see it again, is a rendering of the Miller Station. Top left is Michigan City. And then that slide here, there in the middle on the right, that shows the borders of the project. The project is a 26-mile stretch between Gary and Michigan City, where we mostly run in a single track operation environment. It prevents our opportunities to run more express service. It limits our abilities to have really good on-time performance. When there's delays, all trains take a delay, so there's no recovery period. And it limits our abilities to have improvements in time to market. So significant improvements are going to come when we make this investment. And Pete teed me up for this one. Michigan City today is around an hour and 40 minutes. We'll get to, and I think we'll do better than 67 minutes, but the moment I write something lower than 67 minutes, we don't do it, everybody in here will remember I said that. So I'm writing 67 minutes on the screen, but that puts you right around the Naperville, Illinois kind of area, time frame to and from Chicago. Then, as we talked about, we don't pay those same real estate taxes. We have a better opportunity to get more for our dollar when we purchase them in our homes. We become a region of choice. And I also agree with Ty. We don't need to pirate people from Illinois. They'll come here naturally. But Chicago is a destination because of its economic climate. We need to make Northwest Indiana a place of choice. So when people around the country are looking, where should I locate? They look at Northwest Indiana and say, that's where I want to land, and that's where I want to stay. Once we've educated our children, which we do a great job. Akko, you mentioned what a great job we have from an educational standpoint. You forgot to mention Notre Dame, so I'll mention it now. As part of the great educational fabric we have in this area, but we educate our children very, very well, and then we've been exporting them. Ty showed you the slide about population. We're barely keeping up, and we need to have more places of interest. Quality of place, opportunities. We need to give our youth reasons to stay here. Give them connectivity to the cultural opportunities, the job opportunities that exist in Chicago, Illinois. You can see that we're drastically reducing travel time. South Bend, Indiana, we're getting to 2.5 hours to an hour 45. We have another infrastructure improvement that we're talking to the community out there about that will take another 15 minutes off of that time as well. So they get down to 90 minutes. It's a dramatic opportunity to reduce travel time. We'll also be adding 14 new trains to our service. Specifically, to areas like Gary, as an example, we have trains that we turn at Gary Metro Station today. We're pushing those Gary turns to the Miller community. So Miller is going to go from 28 trains a day today to 48 trains a day when we open up for Double Track. And what I mean by that is we have some trains that start at Michigan City, go all the way to Chicago, they come back as far as Gary. They don't go any farther east, and then they flip and go back to Chicago. It's a main component of our service. Here's my single track a slide that we always show. This is in between Gary and Ogden Dunes. This happens on a regular basis, sometimes daily, where you've got a train that's going westbound in the top right. It's in double track territory, and it's waiting for a train on the bottom left that's an eastbound train in single track territory. That train that wants to go west cannot move until the train on the left clears. We will be creating a 2-lane railroad with opportunities to pass back and forth. Anybody who's driven down I-65, right? You're driving down, and you're behind the semi-trailer that wants to pull out as he goes up the hill. That's what we experience. We'll have passing tracks so that you can go around the traffic that's in front of you. That's the challenge that we're trying to overcome. Here's a rendering of Michigan City. Actually, this is an exciting project in Michigan City, and I heard Clarence is here. Where's Clarence? Skylar might be here as well. Michigan City right now has an RFP to take this concept where we're building a two-story parking garage and get developers to build a 10-story office or retail or residential complex, whatever the RFP winner wants to do. It's an exciting opportunity to leverage the asset that we're building. Oh, let me go back. Just to kind of give you an example, this is a slide from the same location in Michigan City. You can see in a pictorial here what the double track will kind of look like. Now, of course, the trains don't look like that anymore. They're stainless steel. But at one point in time, there was a passing siding, 100-foot or 1,000-foot passing siding in Michigan City, and that essentially will be what the double track will offer here. We'll have 2 tracks the entire length of the system. This is our new station rendering for the Miller community in Gary. It's going to provide a location at the Lake Street location, and it'll be a main hub for our service. As I mentioned, we'll have significant new service out of Gary. The big guy on the right has been one of our project champions. It needs this kind of project needs political project sponsors and champions. Pete Visklowski was that in Congress. I tip my hat to Governor Holcomb. He has made double tracking and the Westlake Corridor projects centerpieces to his legislative efforts. You need people around the country say, how in the world did we, little South Shoreline, we have a capital plan of $20 million a year. How do we have a $1.5 billion capital plan over the next 5 years? And it's because we have leadership and people who have vision and understand what an infrastructure investment like this can do. It's not about commuter rail in itself, which is important and will get more passengers. It's about the development opportunities that can take place and the opportunities for growth that it brings with it. Here's the slide on the bottom left that shows the schedule. I mentioned the pressure that Matt Moss is under to finish this project up by, Matt, end of 2024? Can you accelerate? I think we've given him to 2025, spring of 2025 is when we're looking to open up revenue service on the Westlake Corridor. There was a rendering of the potential for a future station. We worked with our friends in Hammond, and so that was mentioned, and it was shown that there's a potential to build after we finish development, and so there's planning going on right now to build a station in downtown Hammond. Here's the station stops that we'll have along the Westlake Corridor. From the end of the line, which is the border of Munster-Dyer, we will have a 45-minute commute to Chicago. Then those train stops at Munster Ridge, South Hammond, and then we have a gateway station, which is really the marquee station that we have for our service. Gateway is where Westlake and the South Shore Line will come together in North Hammond, and I'll talk about the opportunities that it presents here in a second. Here's the corridor. On the top of the screen, up on the top of the page, is the gateway station. You can see that we run basically a straight line down to the Munster-Dyer border. We acquired property in the late 80s, early 90s from CSX, which was an abandoned rail line. They were getting rid of the Monon corridor. This region had the foresight to buy that property and preserve that property for a potential commuter rail line. Had it not been done, there is no, had they sold it, or it could have just become a bike trail. There's nothing wrong with the bike trail. As a matter of fact, we have a Monon bike trail that we're going to preserve. But had they not preserved it for a commuter rail corridor, we wouldn't be here today talking about the existence of a brand new commuter line. So hats off to the people 30 years ago that had the vision that someday we could build this rail line. And somebody after me can take it the next step farther, because I know there's visions to take this down to Lowell, St. John's, Cedar Lake, and beyond. So there is on the bottom is Munster-Dyer station. The next one up to the north is Munster Ridge. Then just to the north of 8094 is our station at South Hammond. And then up at the end is the Gateway station. This is the Gateway station here. As I said, the Westlake corridor is going to come up from the south along the Illinois-Indiana border. It's going to come into North Hammond, and it's going to take a left turn to head towards Illinois. At that point, we will meet the South Shore Line, and the South Shore Line is basically depicted on the bottom here. You can see there on the left at grade. It's at ground level, and Westlake will be up in the air about 15 feet. We will have the opportunity to have our riders transfer back and forth between the rail lines. So someone can get on in Munster, go to North Hammond, transfer on and go to South Bend, or go from South Bend to Munster, or to Hammond and down to Munster. In addition, because we have this gateway station, we're going to run all new services like we're building generally start off with a small schedule. You start off with 5 or 6 trains in the morning rush hour and 5 or 6 trains in the evening rush hour, and you see how service develops. That's the typical model across the country. We're not doing that here. We're having 5 trains in the morning and 5 trains in the evening, like I just said. But because we can connect into the South Shore Line, we're going to run a 2-car shuttle back and forth between Munster and Hammond. Munster and Hammond. Our riders can then get off at Hammond, walk down the stairs, and jump on a South Shore Line train. That means day one, this area gets full service. It gets rush hour service, off-peak, peak in the evening service, and weekend service. That is unheard of for this kind of brand new opening that we have. That's why it's so key to have this Hammond Gateway Station. Here's a rendering of the station. As I mentioned, you can see here this red line here is the Westlake service coming down from the south. It then turns to the left, and there where all the dots are in the center is where the Hammond Gateway Station is going to be. And then you can see the South Shore Line. You can see where the line is on far right. It says to South Bend. That's the double-tracked South Shore Line, and the trains meet right there. There's preserved opportunity. There's parking for the commuters on the south side of the station. On the north, there's potential for transit-oriented development, which is a key aspect of these projects. This is our typical South Shore platform. This is the model that we use. It's the model that we have at our Dune Park station. Anybody who's been to our station in Chesterton, these are heated platforms. They are very, very friendly to our riders. We have warming shelters for them. It's going to be the design for all of the stations that we build, both on the South Shore Line and on Westlake. So, as I said, starting early in the spring of 2022, please excuse our dust. There will be some inconvenience. We are going to be a construction zone. That happens. And so I'm apologizing right now for some small and minor inconveniences as we build the infrastructure necessary to turn the key and open the service in 2024 for double track and 2025 for Westlake. We kicked off last October, and we had a very small groundbreaking ceremony in Munster. There are so many people we wanted to invite that day to thank. It was in the height of COVID, and so we had, I think, 20 people that were there, including the governor, but we ran a special train. CSX let us put one of our sets of equipment at the Munster-Dyer border on that day. And this is the day we started to turn dirt. And I'm on the left. There's Joe McGinnis, who's my chairman and the chairman of INDOT. The center is our rail fan-in-chief, which is Governor Holcomb. Don Fesco is the chairman of the board of RDA, is to his right. And then Bill Hanna, who Don Babcock mentioned, the then CEO of the RDA. We were there to kick off the start of construction of Westlake, and we are excited that it is definitely underway, and big-time construction will begin in the spring. Those of you who've been along the mainline system have seen that we are in the demolition process in a big way, and I think Pete mentioned that there's not a lot of housing stock. We've acquired 150 homes for both projects. So we have added to that demand on housing availability. We've contributed to the shortage because we've acquired 150 homes, and we have then relocated individuals within the region. I point this one out because it's one of my favorite examples. When I first got the job, they showed me the plans, and this is in Michigan City, and the plans were to put the rail line right through the middle of that church. So I was told, okay, you need to go acquire the church. And by the way, you have the power to take the church if they're not cooperative. So I'm envisioning condemning a church. So I just want to roll that over. That's your job. You're going to knock on the door with the congregation during services, and you say, by the way, you have to leave. We had a meeting in Michigan City where we were talking about property acquisition, and the minister of the church came up to me and he said, Mr. Nolan, I want to meet you. I'm Reverend so-and-so from Bride Church, or whatever it was called. He said, by the way, I was praying for divine intervention. And he said to me, how soon can you buy our church? The roof was struck with lightning and we had a fire. I swear, had nothing to do with it. That's Bride Church as it was 3 or 4 years ago. That's Bride Church today. We have completed almost all. We've acquired about 400 properties. I said 150 homes, a number of businesses, a number of vacant parcels. We've had green demolition. We've had Sealy demolition. They've done a wonderful job, been very respectful to the communities. Here is a construction project we just finished. We're putting in exclusion fencing along the right-of-way because we are good partners with our national park and with our state park to make sure that the construction doesn't harm the environment. So this is exclusion fencing we just put in on the double track project here and finished up a couple weeks ago. This is our parking lot at Dune Park. We're expanding it to the east to be ready for more riders. These guys took down a building that was adjacent to a frame home and within 3 inches of the next door frame home and never touched it. These guys know what they're doing, and that's the site today. Unfortunately, the siding on the place to the north needs a little painting, but it wasn't. We didn't do that. That was there. Next steps for us are really exciting. We know that we've got to do a lot of marketing. I saw the Move to Indiana campaign that Pete was talking about. We want to work very in tandem and closely with Gnaire, with our real estate agents here in the region to help sell Northwest Indiana. We know that private investment is lurking and is actively pursuing us. And we know TOD is coming. We know communities are working on their zoning regulations to make and attract zoning, make investment easier for individuals to come here to Northwest Indiana. So to that extent, we are actually almost finished with a new timetable. We've talked about the times and the savings and whatever, but we're very close to putting out the draft timetable that will show everyone when they open up and look at, you're all going to look at your own communities, what are my train opportunities and what's the time to market? We're going to be putting that out shortly. Now, it's a draft schedule, but it'll give you a good idea of what kind of service offerings we're going to have, what kind of flexibility you're going to have, what's the reduction in time to market. That's going to be a key piece of our marketing brochures that we can't wait to get out. And we're looking at a marketing campaign. We are at an untapped suburb of the city of Chicago. We have the opportunity to tap into the 3rd largest economy in the world, or in the country, 8th largest in the world. We want Chicago to do well. We should not be building this project if we don't think Chicago's going to do well. If you go down to Chicago right now, and I know everybody's got concerns about things that are happening around the world, there are cranes everywhere. They're building like crazy in the city of Chicago. It is a vibrant economic engine. And so we need to continue to tout Northwest Indiana and market it because of all the great things we have. And here's a little note. We've all talked about COVID. We all are hoping that we're coming through and soon are going to put this in our rearview mirror. We have seen significant reduction in ridership. We're not unique around the country. It's happening with all other transits around the country. What we've been focusing on for the past year and a half is what can we do to make sure that our experience is safe. Our experience is something that a family of people will feel comfortable getting on to our trains. I know now more about sanitization than I never thought I would know about ultraviolet lighting and electrostatic sprayers and how long a spray will kill a virus. We have strengthened our cleaning protocols. Our message to our riders is when you're ready to come back, we're ready for you. And we have seen steady upticks in our ridership. Now, nobody's going to do a touchdown dance when they were at 100%. They dropped to 5%. Now we're running about 40% on weekends. But we are seeing week over week over week increases. People are starting to go back to their jobs. Now, we were expecting a big surge after Labor Day, then the Delta variant came out, but that's starting to abate. So hopefully, as we all progress through this this pandemic and more people get vaccinated and we get to a point where this is in our rearview mirror, our service levels are going to be positioned so when we are done with these projects in 2024 and 2025, everything is going to be ready to deliver the service promise that we have and leverage the asset that we've just invested in. Finally, and this is a commercial, one of the things that we talk about is all the opportunities for development, and there's certainly focus along the communities, along the rail line itself. But we're in partnership right now with Valparaiso, and we've got a bus service that they run, and they meet a number of our trains. So that even for communities that are not directly on the rail line, there are opportunities, and we want to see opportunities for growth. We see this Valpo Connect as a pilot project, and so we're hoping that there's opportunities in communities. Ty, I'm going to make you the champion of this. That there's opportunities for communities that are off the rail line that want to send and have bus connectors into our service, so that the asset that we're investing in here, this $1.5 billion asset, is leveraged as far as it can get. So that's all I had today. I thank you for your attention. Sorry, Bill, the train is now running 20 minutes late. Oh, I'll take any questions if you have any.
All right, well, thank you, Mike, and you can certainly understand why I called him one of the men in the arena, right? He's a great champion. I didn't hear another thunderclap, though, when you went down, but I'm certain that helped you with the church, too, so all good. Anyway, we've got several more presenters with some more great stuff. So, and our next presenter, I'll give him a minute to mic up. But one of the things that I did want to comment, and this relates to our folks there from Gary that were asking some of those questions, too, is this transportation-oriented development, it's not going to happen all by itself. So the rail line is going to be a definitely improved service and a great asset. But without communities focusing on planning and development near those stations, it's not going to realize its full potential. So, and that's going to take a lot of hard work at the local level to try to figure it out. So, for example, pick Ogden Dunes, pick Gary, pick Hammond. Any one of those places has had a rail station for some time. Now, the service isn't as good as it's going to be, but I would argue that there needs to be more emphasis around those stations, particularly some of the ones that aren't along the double track, along the new double track, need some real focus and trying to figure out how do we capitalize on that. And I think it ties into some of the stuff that Pete was talking about here too, so some more multifamily housing around those stations and ways to get people conveniently located in a community that can get to Chicago and back efficiently. So somehow I picked up my wrong note here. Anyway, so Bill Sheldrake is the president and founder of Policy Analytics and a recognized leader in economic analysis, state and regional economic development, and public finance. With more than 30 years of experience in economic policy analysis, research, and finance, Bill provides both analytical leadership and firm direction in the carrying out of policy analytic projects. Bill served for more than 8 years as the president and CEO of the Indiana Fiscal Policy Institute, and I think there was some reference to that relative to the financing for the double track, a nonpartisan independent government research organization. Under his leadership, the IFPI conducted research on human capital shortages in Indiana, examined public pension funds, and assisted in development of Indiana tax restructuring legislation, among many other projects. Before serving with the IFPI, Bill served as the Indiana State Budget Agency's chief revenue forecaster, head of tax analysis, deputy director of budget. In his role, Bill was responsible for forecasting elements of the Indiana economy and analyzing all Indiana economic regions. Bill has a master's degree in public finance from Purdue University. And also, interesting enough, a little story with me and Bill. So I think this was about 97 or something like that. We were out at the Port of Indiana, and he's giving this pitch on the potential for Northwest Indiana. And what we really need is a regional development authority. And I'm wondering, what is a regional development authority, and how does that even work? And so he started describing it and started championing it over time. And lo and behold, we got a regional development authority. And we're doing the stuff we wanted to do for years and years and years. So anyway, please give a warm welcome to Bill Sheldrake, Policy Analytics. Thank you.
Thank you, Don. Can I be heard on this mic here or not? Okay, thank you. Appreciate the opportunity. Where does Don get these long bios? I didn't give you that, Don. You shouldn't even have that. Yeah. You should not have that. It's a pleasure to be here and talk to you today. This is a beautiful facility. I just think this is terrific. This is the first time I've been here, and I'm grateful for you inviting me here and letting me speak to you a little bit about the RDA and the work of the RDA and what we're doing that is going to answer, to some extent, the lady from Gary's question about how do communities take advantage of these rail developments. Mike said, and he's absolutely correct, that the rail project, which I would say is now about $1.7 billion, Mike can disagree with that if he likes, and the TOD that is, I'm going to talk to you about how it came about. The TOD that is projected is going to be about $3 billion. So $4.7 billion, and that is now the largest economic development project in the state of Indiana in its history. So we, and I guess what I would say is it's happening now. It's not, this is not hopes and dreams. This is not maybe we can get the grant to do something. This is happening right now. And so I applaud Mike and the work that NICTI's doing to put these rail lines in place. And I'm grateful for the opportunity to help the RDA and the communities that are represented in Northwest Indiana. I don't know if Phil Talon's still here, but that is Hammond's, the pictures of Hammond are some great examples of what communities are doing to respond to the rail projects and to respond to the TOD opportunities. So let's see if I can work this thing. Hello? There we go. Super. So what I want to do is talk to you a little bit about the RDA. I want to talk to you about Mike left out some of the wonderful things that the RDA did to get the rail projects going, which I know he would be happy to applaud if we were up here together. And we actually have shared a podium, I think, in Michigan City one time. We talked about this. But the RDA was created in 2005. It was seeded with both local funds from, actually not local tax dollars, but casino tax dollars that were voted on by the Indiana General Assembly, and about $100 million of dollars that came directly from state general funds. During the last 15 years, the RDA has spent $364 million in projects across Northwest Indiana. And that does not include the rail projects that are coming in the future. So we're talking about shoreline projects, we're talking about Gary airport projects. So the RDA is investing in Northwest Indiana and has. But I want to talk a little bit about how we got here with regard to the rail projects. In the fall of 2016, the Indiana General Assembly had asked a year earlier for the RDA to do a strategic plan. That strategic plan looked at what would happen if the rail lines that Mike talked about were improved, if double tracking was invested in, if Westlake was created. What would happen if you improved the access between Northwest Indiana and the jobs in Chicago? Most people don't think of it this way, but in economic terms, transportation is a cost of life. It's a cost of doing business, and actually it's a cost for you and your family when you're going to the museum. If you can get there 15 minutes earlier, you spend less time messing around and you can get to where you want to be. In economic terms, the time it takes from to drive from Northwest Indiana, or to take the train from Northwest Indiana to a job in Chicago, or conversely, someone in Chicago to come to Northwest Indiana, reducing that time reduces a barrier to what economists call the trade in labor. So simply, you're making it easier. Think of it this way: you're increasing the value of that job for that person who can get to that job in Chicago a half hour earlier. And so when Mike talks about this speed of access, that is vital to all of the things that we would want to see when we talk about the growth of this economy in Northwest Indiana. So the RDA did the study, and I'm going to give you a few things that came out of that study that show why the Indiana General Assembly started in 2017 to really appropriate dollars for the rail projects in earnest. And just to be clear, the RDA is the largest funder. Yes, there's a partnership with the state of Indiana and the federal government and so on. The RDA is the largest funder of these rail projects. And so there's a huge investment that the Indiana General Assembly is making through the RDA, and the RDA is making to these projects. Now, the state is also making direct appropriations to these projects as well, and the federal government is also. One of the things that happens when you improve the economy of a region and when you increase its attractiveness is that you draw in population. So Ty talked about population growth. We'd like to see greater population growth here in Northwest Indiana. This is population growth above the baseline. So if you don't have a rail project, what's happening? Well, there's some population growth, but not much. What happens when you add the rail projects is that you more than double what we saw in the last decennial census. What else happens? Jobs. So more jobs are created, and those jobs that are created are good jobs. So in this analysis that we did I'm going to forget, somebody's going to have to throw a tomato at me if I forget to advance my slides here. So the stationary jobs that are provided and incentivized around these station and junctions are about 1/3 retail, about 1/3 professional services, about 1/3 other services and hospitality. So these are good jobs that are incentivized and brought to the region that take place when you improve that access. Finally, there's development across all of the communities. That's exactly what Mike's talking about when he talks about TOD. That's what Hammond is working to see. That's what Michigan City is working on in terms of their development around their stations. And that kind of investment is taking place, and I'll talk in a few minutes about a little bit more of that. It's now up to about $3 billion projected. The other thing that happens when you increase the economy is that you increase the governmental fiscal resources of the region and of the state. So one of the reasons why this project received a good, when the report was presented in late 2016 to the Indiana General Assembly leadership, one of the reasons why it was greeted with some smiles is because the projections were for about $500 million worth of additional state sales and income taxes because of the growth in this region when you improve that access, when you improve the investment returns in this region, when you improve and increase the population. The other side of that is that that development around the stations, that development of the economy produces about $500 million worth of additional property taxes as well across this region, and that's good for local governments. So the impacts, you know, Don talked about questions that are important to ask. I thought the question that I might seem to be addressing here is the so what. So what about the rail project? Well, the so what is that it improves the economy and it improves the fiscal structure of this region. Let me just drill down here. Mike talked about what he's doing specifically on the rail projects. This says, and I mentioned the rail projects were really seriously beginning to be funded in the 2017 legislative session with appropriations. But the thing that the General Assembly did that is in addition to the rail projects in that year was they created a mechanism called Transit Development Districts. And I'm going to talk about that a little bit because that is the key to why TOD is possible now. I think it will go on for many years. There will be more planning. There will be more development funds made available. But the General Assembly wanted TOD to begin now. In many places across the country, TOD doesn't get started for 10, 15, 20, 25 years after the rail lines really get invested in and really get going. That's not what the General Assembly wanted. They're greedy for their money right now. Oh, did I say that? They wanted to see a rapid return on investment. And so they put a mechanism in place called Transit Development Districts. These districts can be created, drawn around station areas. They are, I don't know if this is difficult for you all to see, but they are enacted by the RDA and then approved by the State Budget Committee. Because they do involve taxes and collection of taxes, they need some state approval. They, like a TIF district, they take only the incremental property taxes and incremental income taxes, local income taxes, and then those revenues are used and must only be used within that district for investment, for infrastructure, for projects. So the General Assembly was putting in place a mechanism to cause development to begin. The RDA is the entity that has the responsibility to draw the districts and then to take those districts to the state for approval. There are 12 districts that the RDA is working on, 12 station areas. The RDA has put together a planning team that is meeting with every one of these communities. In-depth meetings with Gary, with Hammond, with East Chicago, with Michigan City, and assisting in planning, but listening to what the local community wants to see in its district. And I'll talk a little bit more about that in a second. This is what a district looks like. And you might say, so the small dot I have no idea if I can actually make, yeah, so that dot there is the station, and this is an example of the Munster Ridge Road Transit Development District. You might say, that's a weird-looking district. It is, and here are some of the reasons why. The transit development districts capture incremental property taxes and income taxes. The communities want those incremental income taxes and property taxes to be used for further infrastructure, further project subsidies and grants, and so on. So part of the district is to allow for development right around the station, where you might want to have higher density housing or provide infrastructure for walk paths, bike paths, and so on. But part of the reason for the shape of the district is to capture areas that the community realizes is going to be developed or will certainly be developed, and or that the community wants to be developed in the near future. So they want to see that building project go in there at $10 million or $30 million or $100 million, and that those incremental property taxes produce revenues which will then be used to build sidewalks, sewers, electrical structures, some of the bikeways, some of the things that you need for transit-oriented development. So the transit development district strategy is really to provide for revenues to begin the process right away. If the transit development district boundaries, there are 7 communities that have, did I mention that already? There are 7 communities that the RDA has worked with that are essentially the community and the RDA has agreed. The boundary has been drawn. We're ready to take it to the RDA board and the State Budget Committee. If those are approved by the end of this calendar year, then in 2022, they will begin to collect increment. And so the idea is for the RDA and the communities to begin to try to work at trying to get things started quickly in these communities with investment. I didn't mention that the other thing about planning here is that the statute creates a limit for the area of the transit development district of 320 acres, but that can be expanded once up to 640 acres. So there is an opportunity here for the community to get started, start to see some increment coming in, and then after, as they see the pattern of development, make another application, add to the boundary, capture more area, and be able to change the structure of the area such that they're accomplishing more of their objectives. But it does allow the community to get started. I would like to say, Mike showed some great images of communities and what they're aspiring to. I would have to say that the RDA in our meetings with communities over the last 2+ years have seen communities come up with lots of great ideas. Don talked about the people who need to think more highly about the possibilities here in this region, and I would say that I'm encouraged to see a lot of really good high aspirations as we've met with communities to plan for these TDDs. So to me, some of that desire that, Don, that you have championed for many years and I have appreciated is absolutely coming true. I'm going to try to put us back on schedule here, even though Mike got us off. No, Mike did not. Mike did not get us off. I take that back. Mike did not get us off. Just to review this, this is a huge the rail projects and the TOD are huge, huge investments, $4.7 billion. And the thing that is encouraging about this is, as Mike talked about, when he says pardon our dust or coming soon, these are happening now. It's not just the rail projects. These communities are meeting with developers. The RDA has sponsored 2 industry days in which a community like Hammond or a community like Michigan City will have their planning team and engineering team and some of the local officials brought together with developers. The RDA, the other members of the RDA's planning team, MKSK, which is a planning firm that has does work here in Northwest Indiana, does work in throughout Indiana, Ohio, and the region, and KPMG, which is an international consulting firm, and Tiny Policy Analytics are part of the planning team for the RDA. And we put on industry days. We're going to put on some more. The communities seem to really respond well. We've had more than 12 developer firms meeting with the communities, excited about what's going on. And so just to be clear, this is happening now. It's going beyond the theoretical, and communities are excited. So I'm going to wrap up there. I'd be happy to answer questions unless the moderator wants to just drag me off the stage.
No, we're good for a couple questions. Everybody has one?
That economic stuff shuts things down. Yes, Ms. Ennis.
I applaud the entire effort from the RDA and NICD and everyone that's worked on these projects. They really are transformational for the region. So thank you for all of your efforts, and Sherry and Bill as well.
Yeah, I meant to mention that the newly appointed CEO of the RDA, Sherry Ziller, could not be here today. So you've had to suffer through this much less attractive presenter today. So,
Well, you did a great job, Bill. So you'd have to agree with me, and he is one of those people that typically shies away from that. But it was the very first time in Northwest Indiana that I ever even heard of the concept. And then over time, it's like, well, why not? Of course we need an RDA. So it's great to see things come to fruition. Our last presenter, and not least but last, but is Tony Sindone. He's Dr. Tony Sindone, right? Dr. Tony Sindone is
Ordinary man, Don.
is a clinical assistant professor of finance and economic development at Purdue University Northwest, my alma mater. He holds an MA degree in economics from Notre Dame, your buddy here, Mike, with concentration in labor economics and public policy. He also completed all of the coursework for the PhD prior to Purdue. He served on the faculties of Indiana University South Bend and University of Notre Dame. His more than 30 years experience, as well as his research and consulting interests, include forensic economics, labor markets, workforce development, public policy, housing markets, and regional economic development. He's a member of the Regional Council of Economic Advisors for Northwest Indiana and serves on several regional workforce and economic development boards. Today, Tony Sindone, his presentation will focus on economic trends affecting Northwest Indiana, the state of Indiana, and the economy. From a national perspective, I've had the pleasure of working with Tony on a number of tremendous presentations which really started us focusing on our economy in Northwest Indiana and trying to understand gross regional product and how things actually do work to build our economy, putting some measuring things in place. So thank you very much, Tony. Looking forward to your presentation.
Thank you very much. Apparently, the previous speakers broke the microphone to wearing a lapel, so I'm going to be forced to carry this thing around. So, because anybody who knows me knows that I cannot sit still. Okay, so how's everybody doing? Okay? Yeah? Could we go another couple hours, 3 hours? That'd be okay? Yeah. Fellow Domer. Cool. All right. Go Irish. All right, so as Don had said, thank you, Don, for that nice introduction, by the way. What's that? Power onward. Power onward. That's P&W stuff. Yeah, but I was talking to Mike. Yeah, Don, you're the MC. Sit down. Okay, so, okay. All right. So anyway, I want to thank everybody for inviting me here. I want to thank Kevin for inviting me here to speak with you today. And yes, my focus today is going to be on the regional economy, but also taking into perspective the national and state economic trends. And I'll do my level best to forecast because, as you know, over the last several years, this has been done by Micah Pollack, my good friend from IUN. But Micah is on sabbatical this semester, and so he had asked me if I would take his place. So obviously, I apologize right up front here because I'm sure that I'm a poor substitute for Micah. Micah is off doing some research that I'm sure is Nobel Prize worthy, and so we'll see what he has to do or what he comes up with. So anyway, you can see I have a few topics that I'm going to cover here. Thankfully, we have until 5 this afternoon. Yeah, I'm going to talk about the real gross domestic product nationally, statewide, and regionally. We're also going to talk about real income per capita in Northwest Indiana, which is very important to what some of the other speakers have been talking about, especially Pete Nolan, or Pete rather, Novak. Thank you, I got it. I've only had 7 cups of coffee this morning, so I apologize for that. Pete was talking about with respect to housing markets, which is very interesting. And of course, Steve was talking about the equity markets, which was very interesting. Everything seems to work well when you have free money, right? Because money right now is pretty free, right? Or pretty close to free, right? You got 0.5 point, 2 points, 1 point, whatever it is, right? So we could talk about that a little bit later. But we'll talk about real income per capita, labor market trends, of course, labor force participation. We always talk about labor force participation. We did that yesterday. Labor force participation. Talk about the great quit rate, right? The great resignation. Talk about a little bit about population growth and population migration because that's all interconnected. And then I'm going to focus on something I know Don likes to talk about, the positive of Northwest Indiana, which is our industrial strength. Our industrial strength, actually, it is the people who determine our industrial strengths. We're going to talk a little bit about the people and how strong the people are in this particular region. Then I'm going to talk about inflation because we cannot talk about anything with respect to the economy without mentioning the I word because that is rearing its ugly head. We haven't seen inflation like this for decades with any consistency. It will be coming back down. I have some numbers on that. And then finally, forecasts. I'm supposed to do forecasts. Now, my friend Micah Pollack, last time we did this 2 years ago, came out with some forecasts as to what he thought was going to happen in 2020. I just thought I'd let that float out there for a second, right? So I did bring my crystal ball. You'll see it momentarily, and see if I can come up with something that might be useful to us. Okay, so what about the U.S. economy? What do we have going on here? They said I have a pointer. Okay, I have a better pointer than this one. This thing just keeps moving around, doesn't it? No, I got a good pointer. Here we go. There's a pointer, sort of pointer. Okay. So anyway, what we have here is I took a look at real GDP. What's real GDP? This is the actual spending power of our gross domestic product. And what I did is I took a look at this from a national standpoint using 2012 dollars. And what that simply means, for those of you who've never taken my economics class, what that simply means is that we're taking a look at what we could spend in 2012 using the income we have today. And so we kind of break it back to what the value of our dollars are today with respect to 2012. It's interesting. It's good to do that because what we do then is that we compare every year with the same year. And so we really get an idea of the real purchasing power of our income. And so we can see, interesting thing about this, real GDP, we can look at the little graph here, and you can see we're tooling along, boom. By the way, we blame a lot on 2020. But notice what's happening here. The gray area is what happened in 2020. Actually, it started happening in the fourth quarter of 2019. We started to see a downturn a little bit in our gross domestic product nationally. And also statewide, just a little bit. It was normal ebbs and flows. I think it was a normal business cycle. Last quarter, 2019, we just had a lot of interesting things going on in 2019, and then all of a sudden, the first quarter, 2020, boom, we hit that. And then what happened is My pointer died. Okay, I'll have to use their pointer. Sorry. Batteries. What's going on with the batteries? It's right above here, right? No. Red button. I hit the red. I thought I hit the red button. Guess not. Oh, there. Oh, it's got this thing. That's what's happening. Okay. All right. So I can do that. I can do this. Watch the finger. No, I'm glad it's the right finger. Okay. So, and there we had this little bada boom, bada boom. But look at this. We're coming back, guys. We're coming back. We're actually doing pretty well. We can see that our per capita income, or our real GDP rather, per capita later on, had an annualized growth rate for the last 10 years, about 1.65%. Look what happened. Real GDP in 2020 declined by about 3.4%, but then it's bouncing back up. We now have, as of July 2021, a few months ago, our real GDP was at $19.465 trillion. I don't know about you, but I have a hard time wrapping my mind around the meaning of $1 trillion, okay? But just, what's that? Yeah, Don, what did I tell you? Okay, so, okay. Anyway, but that's what's happening nationally. I want to get as quickly as I can moving to Indiana and then, of course, our local area. So we can see state of Indiana, very similar situation. See if I can find the finger again. Yeah, I did. Okay, so we can see that we were rising pretty well in Indiana, right? Then, of course, 2020 hit. By the way, we do want to skip over 2020. I agree with Aso. 2020 never happened. So, it got, the calendar, long-term calendar is going to go from 2018, 19, 21. That's the way it should be. Okay, so we can see here, look, oh, I got a dual. What is with this thing? This is the craziest one. Okay, I can work with anything. Okay, I've worked with children and animals too. Here we go. Okay, so you can see that we are bouncing back. So here's what's going on. I try to be consistent in the way I was looking at this, right? So you take a look at the left-hand side. We can see real GDP. This is doing it to me. April 2021 in the state of Indiana is $351 billion, roughly. Our growth rate is at 1.76%, very similar to the real GDP growth nationally. Real GDP, and this is why I try to take a look at what happened here. Why the fluctuations? And you can see the fourth quarter 2019 and the first quarter 2020, we actually declined by 10.46% in the state of Indiana. That was a huge drop, But we bounced back to give us a net average growth rate of about 2.9%. That's our average growth rate in the state of Indiana in the long run. So we're coming back to where we were. Now let's take a look at Northwest Indiana's economy. Whoa, looks like a roller coaster, doesn't it? Right? Well, that's because it is a roller coaster in a way. So what I did here is I took a look. Again, real GDP, 2012 dollars. In December 2020, we were at $35.55 billion in real GDP. This is real spending power. You take nominal figures, it's going to be about $40.2 billion. But this is what it spends according to 2012 dollars. Again, over the last 10 years, oh, look at this. Over the last 10 years, 2011 to 2021, annualized growth rate near zero. It's actually negative 0.2%. I'll call that near zero. Okay, so we really didn't have much growth at all on average with respect to our real GDP here in Northwest Indiana. However, we did see that our real GDP did grow by about close to 10% between 2017 and 2018. So we can see this big jump up here. I'm probably going to get like a different symbol. Okay. So we can see the big rise here, but then we had the drop off, and it started in 2019. We can see that. It wasn't simply because of 2020. And so I try to wrap my mind around that. Why was that the case? What was going on? And I think we were heading into a normal business cycle towards the third and fourth quarters of 2019. Don't forget, we've had this long run of economic growth and boom throughout the nation, throughout the state, and of course throughout our region for a very long time, probably one of the longest runs we've had in many decades. It's only natural that we would start to see a sell-off, we would start to see some kind of business cycle. And then what happened? COVID hit, boom, right? Then of course, we plummeted, but it was a very short-lived recession, if you will, because of all of the fiscal and monetary stimulus that occurred as a result of our public policymakers trying to overcome the negative economic results or aspects of COVID. Okay, so what about real income per person? Somebody always asks me about that. Let's compare this, and this might look familiar to you, Heather. This is actually lifted directly off of our dashboard we put together, right? And so what I wanted to do is compare the United States, Indiana, to Northwest Indiana. And I did expand that. You don't even have that figure yet, so you're welcome. This one's a little bit expanded from what you have. We can see that while up through 2019 we were on the rise, but still below Indiana as well as the nation. But really pretty much at par of what we have been seeing over the last 5 or 6 years, shortly after the recession. Remember, back here is when we had the recession and we started to come back up, dipped down a little bit between 2015, 2016. That's every single figure I've seen from Northwest Indiana, we did that. 2015, for some reason, we went down. I think it was just normal business cycle moves, but a very slight business cycle. Then we come up here, 2019, doing well, and then, of course, we moved to 2020, which was a very exciting time. So we can see that COVID-19 had a very adverse effect on real per capita income in 2020. Okay, here we go. Now we're going to talk about some fun stuff, right? We're going to talk about some things that we're all concerned with. Job trends. Not only job trends, but also labor force participation. So we can see here that I only went about 5 years back, and then trying to make some projections going forward. So between 2015, 2020, jobs actually declined by 4.4% in the 7 counties. And we can see what the number of jobs are. Jobs went from 345, 138 to 129, 932. It fell short of the national growth rate of 0, because the national growth rate in jobs was really 0. And so since we had a decline, it went down by 4.4% compared to the nation. But what I'm seeing is that we're going to go sideways for a couple of years. And somebody else here mentioned that we're looking at 2022, probably the first or second quarter of 2022 before we start really recovering. That, of course, is assuming that no other random stochastic events occur, which we don't know what's going to happen. But that's what we're looking at here in terms of jobs. And as also pointed out earlier, the jobs that we're going to see in 2022 and beyond are not necessarily the jobs we have today. Right? Because what we are seeing is a transformation of the skills required for the jobs of the next 5 years. And this is where a lot of the educational institutions play a very vital role in trying to train the workforce for the jobs going forward. And if anybody's ever heard me speak in public before, you know that while I'm a fan of education and training and so on and so forth, I'm a bigger fan of teaching people how to learn new things. Right? Because I can tell you, I don't know what the technology of the future is going to be. I have no clue. Right? I don't know what's going to happen 5 years from now, even though they're asking me to do that. I don't know what's going to happen 5 years from now, but I do know it's going to be different. And I do know the jobs are going to be different than they are today. And so whoever is in our workforce at that time must be able to adapt. Unemployment rate trends, they're going down. Unemployment's going down. It's a good thing, isn't it? Doesn't it sound like a good thing? Unemployment's going down? Remember how we calculate unemployment. Unemployment is the number of people who are unemployed divided by the number of people in the labor force. However, we're seeing people in the labor force leaving the labor force. And they're leaving at a very high rate from a historical perspective. And what happens is that our unemployment rate would still be going down, where we're hovering about 5.7, 5.8% right now in the region. But what is really causing this is I'll come back to that. Our labor force participation rate trends. Labor force participation rate has gone down to just over 58%. Yeah, I see your face there, Matt. Okay, yeah, it's not good, is it? Right? Because people are not going back to work. Now, why won't people go back to work? By the way, by show of hands, how many employers do I have in the room here? How many employers, okay? Now, keep your hand up if you're having a difficult time finding people. Well, even more people put their hands up. Okay, fine. I mean people for work, not people like to date or anything. Okay? All right, thank you. We're all finding that, right? We're all finding that difficulty finding workers. And why is that? Some people would say, I've heard all the stories, right? Some people say, well, it's because they got the $300 more for unemployment, okay? So they didn't want to go to work. Well, that's over with, okay? I've heard some people say, well, they just want to stay at home because they're used to staying at home. Well, maybe there's some truth to that. Here's the thing I take, and here's the way I look at it, and it's kind of a thing I take too. We got used to working at home. We got used to earning income while working at home. We got used to taking care of our kids while we were working at home for income. The kids had to stay home, right? They were kicked out of the school. They said, go home. Now you have to teach kindergarten in addition to your job, right? I remember watching my little granddaughter, Gracie, playing a video game on one iPad and taking a class on the other one. Okay, I say, Gracie, she was in kindergarten, first grade, I'm sorry, at the time. I say, Gracie, what are you doing? I'm in class. But you're playing a video game? Yeah. Do you like school? No. I'm not kidding, it's true, it's a true story. And I'm going, Gracie, are you listening? She goes, well, I turned off the video so she can't see if I'm here or not. She admitted that to me. I said, turn the video back on. So we got that. Yeah, I'm a cruel grandfather, yes. Yeah, but I wanted to learn something. She probably learned not to invite me over to watch her anymore. All right, so that's what we're seeing, labor force participation rates. And actually, we could see some volatility going back to some information that Kevin had sent to me about union construction man hours. We could see this over time. The latest figures I have, 2020, 2021 has come in, but it's only a few months worth, but it's also trending downward as well. And why is that? Well, construction projects have not been as robust as they had been in the past. So we're hope to see that picking back up again after this winter season. So we'll see how that works. Okay, going back here. Speaking of people who quit their jobs, this is a slide that I put together from the Bureau of Labor Statistics. They actually came up with quit rates. And you can see historically at the quit rates going back to 2001, the total non-farm quit rate, we can see it's just kind of normal. And then, of course, during a recession, people don't quit their jobs. Sometimes they lose their jobs, but they don't quit their jobs. That's what the gray areas are for, by the way. They are the recessionary time periods. And then, the quit rate started rising again as economies get better. By quit, by the way, it means not necessarily taking yourself fully out of the labor force. It just simply means quitting one job maybe to go to another one. Because we're seeing a lot of that in the workplace too. I bet you are, right? And we'll talk more about that in a minute. But then look what happened after the again, we have to get us a new one of these. Okay, here we go. Something. Okay, over here. All right, we can see what's happening. Got to make it work. Over here, we can see the big dip. Okay, again, recession. We didn't quit our jobs, but now we're quitting our jobs in a tremendous number. I think what it is that people are used to being home. As I said before, they think that they can, a segment of our population thinks that they perhaps could also earn income while staying home. So they're looking for remote work. I have students who are, asking me for recommendations, and I do give recommendations to some of my students to employers, and I know a lot of employers, I know a lot of you, and I'll make a phone call. I say, oh, you should hire so-and-so, And then I find out later on, they said, nah, because I asked, did you get that job? No, I decided not to take it. Why? Well, because they wouldn't let me work remote. I said, don't ever ask me again. I'm friends with many of you in this room. Don't do that to me. I don't want to do that. So, but we are seeing that. More people wanted to work remotely because they think they can. And, sometimes they can. But here's my take on it, too. Look, workers got beat up during the COVID, right? People actually did the work. I say, and I'm using that term, they got beat up. Think about retail workers who stayed. They had a skeleton crew. Customers were complaining about every little thing in the store. You're not working fast enough. Look at in restaurants and hospitality industry, which took a tremendous hit during COVID, right? But there were people who went to work, right? But the service was spotty, and it wasn't their fault, but they took the brunt of it. So they got beat up for months on end. And now we're saying to them, oh, yeah, everything is opening up again. We're going to open up full hours and everything else. And some people are just saying, I'm done. I'm done. I need a break. So I think we're seeing more of that than the fact that, you know, the $300 stimulus payments or whatever they were, right? And of course, the initial, the checks that a lot of us got, we didn't really need because we were working, right? But how many people refused that stimulus check? Yeah, like I said, okay? We all took it, and it was like $1,200 or $2,400 for a couple, that kind of thing. We all used it, we spent it, or we saved it, or we paid old bills with it, okay? So maybe some of those savings were built up. People didn't go shopping, right, as much as they did, at least outdoors. They did a lot of online shopping, as Ty pointed out, right? But what they also did was that they didn't do much travel, so gasoline prices went down, right, because the supply and demand. One of the reasons I became an economist, folks, is because it just intellectually made sense to me. Because human beings, being as we are, human beings violated every law we've ever written. We have. Every single law. I don't care if it's religious laws or codified laws, whatever. We violate every single one except supply and demand. Supply and demand works. Right? And so we see that. Basically, your answers to why things happen is 1, follow the money, 2, supply and demand. Hey, Tony, is that orange line up there, is that leisure and hospitality? That's what I was getting to next. Yeah, that's leisure and hospitality. That's just leisure and hospitality. Look at all the people that quit, including this device. How come every time I press that thing flashes? No, it's not working. Okay. Yes, leisure and hospitality. They're the ones staying home the most. They're absolutely correct. Okay, move on. Talk about population. All right, now, interesting thing about the population growth in Northwest Indiana, we actually had a loss of population for some time. We can see here from 2011 leading up to 2019, we rarely have had an increase of our net population. The orange is Northwest Indiana. But look what happened in 2020. This is, again, from the dashboard, okay, that we put together for the forum, okay? And this is incredible. So where did that come from? Where do those people come from, right? Well, fertility rates if they haven't leveled off, they've actually gone down a little bit, okay? So mortality rates had exceeded fertility rates for some time here in Northwest Indiana. So where are the people coming from? Well, we're going to take a look at that. Well, this is just general population increase. We are expecting population to grow here in Northwest Indiana. We expect between 2020 and 2025, our projections are 1,116 people. We'll see how accurate we are in 2025 if I'm still here. But then I want to get to where they're coming from. Okay, this is really an interesting data. It's a very busy slide, but we can see where some of the people are coming from. Okay, so these are the counties that people are coming from, a lot of it from Illinois, okay? But don't forget, we also sent people to Illinois. Somebody pointed this out before, right? It is a two-way street. We have population coming here from the western suburbs and Chicago, and we have some people going out that way. All right, this is a very good picture of where our net migration comes from. All right, so again, these slides will be made available to you, but you can see where they're coming from, and they're coming from all different areas. We're talking about Michigan, other counties in Indiana. Apparently, we had 351 people go to Maricopa County, Arizona. Who knew? But that's what we did. Okay. What is our strength of Northwest Indiana? Don can speak to this very well, right? Our industrial strength, and of course, the people that make up our industrial strength. One thing I want to point out, we are a manufacturing region. We cannot get around it. 31% of our gross regional product is in manufacturing. I heard rumblings when I started doing these presentations. When you and I started doing this, Don, back in 2011, we said, I kept hearing, oh, we need to transform us from a manufacturing economy to a service economy, to a high-tech economy, to become the next Silicon Valley. No, we're not going to be the next Silicon Valley. Silicon. Is it? It's my Italian showing. I don't know what to tell you. Thank you. Yeah. Silicon Valley, that's what I meant to say. Because we're looking at, possibly we can manufacture semiconductors. We're looking at that, aren't we, Marie? Right? Looking at manufacturing semiconductors in this region, but it's still manufacturing. But manufacturing today is not the same as it was 20, 30 years ago. Manufacturing today is very high technology, using a whole lot of high technology, using the skills that are required of technologists, if you will. And so that's what we're looking at here. Again, to try to get this to work. So our top industries in terms of gross regional product, of course, manufacturing. The next is healthcare and social assistance. Don mentioned that we graduate 700 nurses a year. And you asked the question, why? Old people like me that are going to need them. Okay, so I'm glad. Anyway, government, you can see where it is. But manufacturing definitely dominates our gross regional product. What about in terms of jobs? Healthcare and social assistance, #1 job creator right now in this region. Manufacturing is a close second, then government. By the way, in these data, government also includes public education. So we do have quite a few people who are working in that industry. Top growing industries, who wants to be a truck driver? Right? You take a look, you mentioned this before, Ty, right? You take a look at the top jobs that are in demand, and it's been like this for the last 5 years. It has been for truck drivers, long haul and local truck drivers, right? All those packages you're having delivered to your house, they have to ride over our roads and our rail, right? But predominantly our roads. So yes, the #1 job in demand is in transportation and warehousing. And I'm glad that you and I agreed with that one, okay? Healthcare and social assistance, we're seeing more demand in that way as well here in the region. What about top earnings? Utilities, got to pay his pension, right? So utilities, top earners, management companies, enterprises, manufacturing. Manufacturing has always been in the top 2 or 3 in all of these categories. We will not move away from manufacturing, but the manufacturing is going to be different than it had been. And so that's where we need to focus our attention. That's where we need to focus our policy on. All right, the strength of our people. Where are we getting our largest occupations? They're in office and administrative support. These are the categories or occupations that have the most people in them. Sales and related, you might imagine that. Production is actually down to #4, and that's only because it takes more people to do administrative support. That will not always be the case. What's happening is that those groups up here, sales related, office support, they're the ones staying home. They're the ones staying home. What do you think is going to happen in those industries? What do you think is going to happen in those companies where the people will stay home for a long period of time? Are they going to be replaced? What will replace them? Technology, automation. There are 7 McDonald's franchises right now in the city of Chicago that have gone full AI. They're experimenting with them. Full AI. They have 1 or 2 people in the back that just to make sure the machines are running. But what they're, pardon? There's seven of the franchises. There's only 1 or 2 people in the back to make sure the machines are running. And you pull up, you actually go to the front if you want to. You could use your phone to order it, pre-order, right? You walk in, there's a kiosk, you press the button, you get your Big Mac and fries, okay? And then you just kind of wait, and all of a sudden it comes out on a conveyor to you. There you go, there's your Big Mac and fries. That's what they're experimenting with, all right? What's gonna happen to all those workers? They're being replaced, right? You think you could do that in office workers? You think you could do that with accountants? I hate to pick on accountants. Can we do that with accountants? Can we just simply replace accountants? Yeah, but we still need humans to make decisions, right? But in terms of the day-to-day, we're going to see accounting is already changing with technology. So there are big changes ahead. Okay. I know I'm really long in time here because the trains were late. Yeah, that's what I heard. The trains were late. I'm just sitting there, and the trains were late. The fastest growing occupations, well, there's about a bunch of old people like me, nobody in this room, but a bunch of old people like me that are going to demand health care. And so that's the largest growing population. In production, and again, production workers are going to be significantly different going forward. And so you can see what the rest of these are, right? Computer and mathematical, not that much, but these are still fast-growing occupations. Top posted occupations, here we go. I mentioned this before, and Ty, agreed with me before about transportation and warehousing. They have the #1 postings on various employment websites. Number 2, of course, would be healthcare practitioners and technical, mostly nurses and nurse practitioners, right? And then going so on and so forth. Sales and related. It could also mean retail sales. It could be remote sales. It could be online sales. We are looking for those folks here. So where are we going to get those folks from? That's a question. Here are some of our skills that are required. Many of these skills can be crosswalked in merchandising, nursing, as we said, trucking, that sort of thing. I'm going to move fast past this because people are getting antsy. Where are they going to come from? Oh, I have to do a little bit of a plug for P&W. 2020, we graduated 2,298 people, okay? Followed closely by Valparaiso University at 1,170. IUN is 697. And we can see the graduation trends here. Our graduation trends kind of leveled off for P&W. It's gone down a little bit for Valpo. It's gone down a little bit for IUN. And one of the interesting things, because I did a query for the top 10 in the region, top 10 education institutions in the region to see what their graduation levels were. Nowhere in there would it have Ivy Tech, because Ivy Tech reports the entire state. I could not get data specific to Northwest Indiana. But I did look at Ivy Tech for the whole state. It graduated over 29,000 people, awarding over 20,000 certificates and 9,000 associate's degrees. Ivy Tech is a great resource for us. It's a great feeder resource to the four-year institutions. It's also a great resource for those people who don't feel like they need to go to college, go to a four-year college. But most people do need some post-secondary education and training, and Ivy Tech does a real good job of doing that for us. All right, inflation. Somebody mentioned inflation before. Let's talk about the reality. Here, when you go to the store, okay, I actually looked at, and I think my rates of inflation are a little bit different than Steve's, because I think Steve went up to August, I went up to September. And the reason I went September is because I guess I got my slides together later than Steve did, but that's okay. It kind of works, because take a look at this. All items, we're at 5.4% inflation rate. But then I took a look at, how about the month-to-month inflation, just the last month? It's at 0.3% for all items. That's still pretty high on a month-to-month. Then I said, gee, I wonder what specific items are. How about food? Because these are things that we actually buy every day, right? So food at 4.6% for the year, at 0.8% in the last month. And what do we buy mostly? Well, I'm not a vegan, so I buy meat, poultry, fish, eggs, okay? And that's at 10.5% for the year, or at 1.7%. That's still pretty high. How many times have you gone to the grocery store to go buy, I don't know, a flat iron steak, and it's now, instead of being like $6, it's $18 for the same thing? And what do? Do you buy it? No, I don't buy it either, right? That's supply and demand. Because what happens is that you go back the next day, oh, it's down to $9 again. Why? People didn't buy it. It's a little brown, but it's okay. So, all right. All right, energy. We talked about energy, 24%, 24.8% inflation rate in energy. In general, gasoline was 42. That's September to September. Steve was looking at, I think, August to August. And so it is coming down a little bit. Last month it was at 0.3%. Electricity, again, we have to pay Don's pension, was at 5.2%. Month to month, it was only at 0.3%. But take a look at used cars. This is one thing that was huge, right? How many of you tried to buy a used car over the last, I don't know, 6-7 months? Yeah, there you go. How fun was that? Not fun. Now, is anybody in the used car business here? Okay, we can talk freely. All right, so yeah, used car prices went crazy. Why? There was a shortage of new cars, right? And you know, here's the thing, if there's a shortage of new cars, that means fewer people are trading in their old cars for the new car. So the supply of used cars dropped dramatically. And when supply goes down, and then we have young people wanting to buy a used car, what's going to happen? The price of that used car is going to go up. Prices went up dramatically, but they're starting to come back down to earth. All right, so just hold off. Just walk a little longer, and you'll be fine, okay? At 24.4%, you see it's coming down at a rate of 3.7% in the last month. And I suspect next month it's going to go down another 4 points. That's what I was looking at. So, okay, producer price index. This is something that that we largely ignore, but these, of course, are the inputs to everything that we have to make, right? And so I took a look at, again, some selected items that that seem to be important in our supply chain, or at least to as inputs in our supply chain. And I looked at the ones with the highest rates. Fuels really stuck out at 43.5%, one-year inflation rate. Utility natural gas at 30.1%. Again, largely due to fuels, because it takes fuel to generate electricity and other utilities. Utility natural gas, just the natural gas part of it, 30.1%. Again, that's a supply and demand thing. Lumber and wood products. How many of you try to renovate things in your house? Somebody try to build something on your house, construction in your house over the last year? How many of you tried to do that, right? Yeah. Was it a joy to go to Home Depot and see the price of drywall and 2x4s and all that? No, because the prices really went up dramatically. Again, supply chain issues. You couldn't find wood, right? Now you can, a little bit. And the prices are starting to come down. I was supposed to put a porch on my front, in the front of my house. That wasn't going to happen over the last summer, although I had time to do that. So we see inflation is coming back down. All right, forecasts. What does the future hold? I don't know. Let's see. Forecast. Let's say I put more question marks there than not question marks, right? So here's my forecast for 21-22. And this is based on analysis. This is based on econometric assessments. And I'm going to say, and I'll put it out here in public, you can record this, because I'll come back next year if I'm asked to. I'm saying Northwest Indiana's real gross regional product will be at $37.15 billion, okay? Which implies a 4.5% growth rate, okay? I think a 4.5% growth rate is going to work. The reason being is that we are starting to trend back upward. We had it at 2.6%. I think towards the end of this year, we'll start seeing an annualized rate of a little bit more than 3%. So next year at this time, I think we're going to be at 4.5%. Of course, there's some caveats I have listed down below here, okay? I think the unemployment rate is going to be at 4.2%, especially if more people stay home. No, 4.2% because more people are going to get hired in order to work the growth in our economy. So I do see a continuing downward trend for the unemployment rate. Now, of course, as I said, there are some caveats here. The factors affecting such forecasts, and it's like a list of 20 items, but these are generally what I'm looking at here. I said besides the unknown, we don't know what stochastic events there are. I heard there's another Delta variant out there, not the Delta variant, but apparently there's another Delta variant plus, Delta variant part 2, 2.0. I don't know what there's stuff going on out there. But also fiscal and monetary policy. Fiscal policy, some people spoke about this already. Stimulative deficit spending, we're seeing a lot of that. And the infrastructure spending and future relief spending, of course. The federal government is throwing a lot of money into the system. Question rose before, why didn't we see inflation until just now? Because we also had this thing called quantitative easing after the last Great Recession, or during the last Great Recession, right? To the tune of $85 billion per month that the Federal Reserve bought treasuries, okay? That was the rate they bought the treasury, $85 billion a month. And yet inflation did not happen. Why? Well, here's the thing. This is what they don't tell you, okay? The Federal Reserve bought treasury notes. Treasury Department took that money and said, okay, we're going to pay off other treasury notes with that money, and then we're going to come back and borrow that money from the Fed, okay? So the money went through literally across 4 buildings in D.C., it didn't hit us. We did not get that money in the economy. This last round of stimulus, if you will, both monetary policy and fiscal policy actually hit us in our pockets. We got checks, we got money put into our bank account. We got blips on a screen put into our bank account. We got numbers that got put into our bank account. Somebody asked before about cryptocurrency, right? Oh, what do you think of crypto? It's fairy dust, okay? What do you think of the U.S. currency? It's fairy dust, but we have confidence we could use it. That's the difference, right? That is absolutely as long as we have confidence in our monetary system, it works. It's not backed by anything other than our confidence in it. All right, so anyway, if the monetary policy is continue to become what we call accommodating, okay, meaning government runs up deficits, the Fed throws money out there to keep interest rates relatively low, then we're going to see, I think we're going to get pretty close to my predictions here. Okay? And that's the key if the monetary policy continues. I'm not saying that it will. I think there's going to be pressures to slow down monetary growth starting in the second, maybe third quarter of 2022. Because as someone had said earlier, the government doesn't want to spend more money than it has to, or doesn't have to pay higher interest rates than it has to. It doesn't matter, because all the government will do is they just simply borrow more money to pay the debts. That's all they do. Like I said, fairy dust with confidence. Okay, so here, that's my forecast. So now, what I remembered from last time I spoke with you folks is I actually did a little economic analysis about the Indiana Dunes National Park, the brand new national park. I was here 2 years ago to do that, right? And so I came up with some predictions then. And you might remember, and I'll say this from yesteryear, this was actually my slide that I had used that particular day. And I said my forecast, it was using 2018 data for 2019, okay? These are just multipliers up here, but I'm going to get down to this. My 2019 estimate for visitorship in our Indiana Dunes National Park, I said it was going to be a 21.5% increase with visitors over 2018. There was 21% greater than 2018. And the GRP contribution is estimated to be about $128 million, okay? And I'm estimating an additional, or actually supporting 1,138 jobs. Okay, so then I started looking at it this year, and I'm going, okay, how close did I get? Let's see. Well, this was the graph from last time, and I started looking at the graph from last time, going, oh no, it's gone down. Uh-oh, uh-oh, uh-oh. And then I took a look at the new data. Ooh, look at it. New data is going up. How far up? This is 2019, and this is 2020 right here, okay? So let's see the numbers, all right? From 2018 to 2019, boom! Look at that, huh? Huh? You're welcome. Thank you. Yeah, I've never been this close, okay? But this works, okay? And in 2020, we're actually, I'm seeing a continued rise. I thought in 2020 people would stay home, but they didn't. They went to the parks. Why? They could. There weren't that many other places to go in 2020. How about 2021? Here's my prediction for 2021, okay? Well, these are the actual raw numbers, by the way. For 2019 and 2020, GRP contribution was at $140 million, and which is very close. And by the way, in 2019, it was 129. I got that off also. Remember 29? Yeah, 128.6. It came out to 129.7. I apologize. I missed that one. Okay. So anyway, here's my next expectation. So again, record this. We'll see what happens. Okay? I'm estimating a 6.4% increase of visitors over 2020, and my GRP contribution is estimated to be $149.6 million, and estimating 1,312 jobs. So we'll see how close I get for the Indiana Dunes. Okay. And I guess I'll open the floor for questions, but I'm like an hour late, so I apologize. Any questions at all?
So let me suggest that we can blow Tony's prediction out of the water by having more focus on gateway communities to the Indiana Dunes. mean, this South Bend is already kicking our butt relative to their advertising. We're the gateway to the Indiana business. I mean, they're 45 minutes away. Every single one of our Duneland community, if you will, starting from Michigan City all the way over to Hammond, should be advertising as themselves being the gateway to the dunes and helping us, you know, build our economy by having people recognize that Northwest Indiana is a great place to visit. Because you can recreate here, you can have a job here, you can get a great education here, and you can raise a family. So, I mean, it doesn't get better than that. And Tony, great job.
I want to be wrong on that prediction. I want to make that an underestimate. So, all right, thank you, Don. Appreciate it.
Well done, Tony.
Thank you.
Thank you. Thank you very much. So, accurate forecast. So let's bring up Otso again one more time here for a close. Isn't this a wonderful facility? You know, this is dreaming about what really could be. So, Mr. Sakowsky?
Thank you, Don. Wasn't it that nice, right? At least we are doing something right. We are going in the right direction. And why we are going in the right direction? Because of you, because of us working together. Can't wait to see what's going to happen next year and the next 5 years. Thank you so much for being here. And as I said this morning, please round of applause for Don. Forgot that. Sorry. Come on, Don. Done awesome job. Thank you. So if you have time, I would like to show you the simulation lab. And in fact, we have students upstairs and they are doing simulation. So those of you who wanted to come and see, why don't you come up here by the podium, and then we're going to walk upstairs to see the lab. Thank you again, and have a wonderful weekend.